What's going on, guys? It's not Gav behind the account today. It's Sam, one of his team members. So it's good to finally meet you guys.
What's up, Sam? How you doing?
I'm doing great. We'll get a few more people up on stage and we'll kind of go through. Hopefully, your guys' days are going well.
Not too bad, Sam. Not too bad. Nice to have you here.
Dude, awesome. Let me get a few more people up on stage and then we'll kind of go from there. Here we go. We got Paper Gains up here. BK, is that you behind the account?
That is me.
Awesome, man. How's your day been?
It's good. It's good, man.
Awesome. What have you been looking at market wise?
Man, I've been Bitcoin, of course, is really interesting here.
Okay.
MicroStrategy was a little ahead, and actually, I think I saw closed down today. But I think we're starting to see some confirmation of possibly a trend break outside of Bitcoin 60K. So that's exciting me. China names actually seeing a lot of the ETFs leveraged and both otherwise really start to build some volume. So yeah, excited about China. Just need to see a range break.
What's up, BK? Hey,
Hey,
Sam.
Evan, how you doing?
Sam, drop me co-host.
No, Sam, drop me co-host.
I'm sorry, Evan. I already dropped Gav co-host.
All right, I know where the loyalties lie. It's okay.
Yeah, you better. You
So
guys
Wolf, did I
ready?
win?
Actually, let's take a little look.
I can't be far off.
Unfortunately,
I think Evan won.
you did win.
Bang bang! 2 out of 3. The double champ does what he wants. All right, I'm leaving the space spot. No, I'm kidding. I'm excited for this one.
It actually wasn't that close.
I killed it.
Papa Paper took second.
What was my second pick? I don't even remember.
Connell killed it for you. Your other pick was Yin, and
No, it wasn't.
It was.
No,
if you remember.
it wasn't.
No, it was because you
No,
made
it
me
wasn't.
change it to you, and it was something else first, and then you had me change it.
Off of Yin.
No, it was Yin. You had me change it to Yin.
All right,
I'm pretty sure.
I will get to the bottom of
I'm
this. I'm going
100%.
to last week's recording.
Yeah,
Someone go, because I'm pretty sure that he had me change it. And actually, let me double check the tape real
I'm
quick.
100%.
Let me double check the
I
tape.
had to change it off.
All right, let's check. All right, here it is. Double checking the tape. Wait, was your other one not? Was this 2 weeks ago that you did AGQ? What was your other one? You picked something else. You picked AMDL. AMDL, wasn't it that?
Oh yeah, that sounds right.
Okay, wow. Can't believe that was a legendary pool for my brain.
That was actually pretty good.
Yeah, I don't think AMDL would have helped you, Paper.
You do have him as AMDL and CONL on the. Here's our stock picks for
All right,
from
I take
tonight's
it back
competition
then.
space.
Up from when we started it. It's just
All right,
not,
I take
not
AMDL back, and unfortunately, it's still
land me second place.
You're closer. You're a little closer. You're 1% closer to first.
There you go.
Shout out as
it.
well to all those that participated. You're all winners in my eyes, because we had one of our best weeks out there. Unless you were Jordan and you picked TSLT prior to the Tesla event, in which case I am sorry for your loss. That was a rough one, but outside of that, we killed it. We averaged, if you took all of our picks, 7.31% return across the board, which is really, really good for a whole bunch of people all making 2 stock picks in a week where SPY and QQQ did not go up 7.3%. Trust me. It's been a long time since they did that in a week. Okay, I know we need to get into this, and I know a couple of you need to give your stock picks early, so let's get rolling. I'm going to turn the mic over actually to Sam. Sam is a valuable member of the Wolf team, helping us out tonight because I have to get into an Uber in 35 minutes to go to the airport. I'm still going to be on the space, and I am going to get to the airport, get into a lounge, and moderate another space after this. But life of a Spaces host, Sam is going to help out. I think he pretty much understands the outline of this, so we'll kick it off with Andrew from Market Sentiment. And then, Sam, you'll take it from there, just kind of calling on people going around.
Awesome. What's going on, everyone? Yeah, in terms of market sentiment, what I'm seeing this week, when I look at sentiment specifically, market participants are starting to get pretty bullish on the market, and their exposure levels are definitely increasing. We see the Naeem Exposure Index, which measures active equity fund managers. As of last Tuesday, it was at like a 90 something reading. And that's before we had even more of a bigger rally in the S&P 500 and a lot of these growth stocks. We look at retail investor sentiment, definitely going higher. So yeah, it's definitely getting up there. If you look at the CNN Fear and Greed Index, it just hit extreme greed. And this is all going into a presidential election cycle where I don't think anyone truly knows what's going to happen. Sentiment is getting a little bit more heated. In terms of what I'm seeing in the market, the dollar index has ripped higher off of its lows, and we're seeing bond yields move up very quickly. So whenever I see bonds getting hit and I see the dollar index rallying, that always gets me a little bit more cautious on the market. One of my risk indicators actually just flashed a sell signal into the close on Friday. So I took off some exposure today via common shares as well as call options I had on some companies. And I actually added some shorts to my book as well. So we'll see what happens. I mean, it just seems like everyone is really racing to get exposure into the election, for better or worse. I think at some point there will be investors that are looking for hedges. As of right now, they're not. The equity put to call ratio, if you look at it yesterday, or on Friday, was incredibly low. So yeah, investors really not interested in adding those hedges at the moment. So we'll see what happens. But for this week, my picks, they're going to reflect that more cautious, bearish view on the market in the immediate term. So for my picks, I'm going to go with short SPY for my first pick, the SPY ETF. And then for my second pick, I'm going to go long the MSOS Cannabis ETF. I think no matter which candidate wins the presidential election, I believe that cannabis is going to get rescheduled from a Schedule 1 to a Schedule 3 drug. That process will likely kick off on December 2nd. And when that process kicks off, there's going to be a big tax benefit for a lot of the multi-state operators in the cannabis space. So perhaps this week MSOS doesn't do a whole lot, but that's really like the big trade that I'm looking at into the end of the year. So yeah, just to recap, my picks for this week are short SPY, then long MSOS. Thanks for having me up.
Awesome. Thanks for coming up here, Andrew, and great to be here, everyone. It's nice to meet all of you, or nice to see you guys again. We'll go over to Jaguar first, and then we'll kind of keep circling through.
Yeah, good afternoon, everybody. So, in terms of the market, it's important in my view that the yields, starting off where Andrew left off over there, the 10-year bond yield has risen almost 50 basis points off the bottom. Purely from a technical standpoint, 4.17% is the key resistance level on my charts. I think it's important for the 10-year bond yields to make a stop right here. We are less than 10 basis points away from that. But if we don't, and the 10-year bond yields continues to climb higher from here, then I think that it is going to be interpreted by the market as a little bit risk off, right? Because it's rather surprising that when you think that where the Fed basically cut by 50 basis points and we have had exact opposite reaction in the bond market. And so 4.17% is the key. If we don't stop there, we continue to move higher, then I think the market is trying to tell you that something is off. So that's on the technical picture side. Overall, we're going into the earnings season. And I think just like us as traders sitting over here trying to figure out, right, what lies ahead 2 months, 3 months, 6 months from now, I think that corporate America is doing exactly the same thing based on their expectations as to where the policies will change depending on the election outcome. And so I think you're going to get a sense in this earnings season that the guidance for Q4 and beyond is going to be a little bit muted. I don't expect green shoots in a significant way where everybody will come out guiding sharply higher. I think they're going to wait until everybody is going to see the election results when the volatility starts to subside, and then I think you could see better guidance to emerge starting from early part of 2025. So the risk, in my view, going into this earnings season is that a little bit on the disappointment side on the guidance, but that's to be expected. Whether it results in market correcting rather sharply, I don't think so, but a few percentage points of pullback at some point would not surprise me. Those are my high level view. From this point on, whenever I'm on these spaces, I'm going to focus on specifically earnings as catalyst to call out these names. And so, unless there's something else outside of earnings, my goal with all these picks every single week is to have catalyst driven trades because these are weekly contests. So let's do that. That's it from me. I'll come around later with some ideas.
Thank you for coming up here. I agree. We'll go over to Paper Gains. Go ahead, man.
What's going on, man? Yeah, I think I'm torn actually right now. We had an amazing freaking day. And the market's been mostly sideways for the better part of 2 weeks or so, and we're finally just breaking through this range. My only hesitation right now is we've been pretty sideways for a while, and then if we have another big green day like we did today, then that would likely put the market into a bit of a stall momentum. And I'm just ahead of earnings. I think the market can get a bit ahead of itself, so I do see something like that happening where we actually continue on higher tomorrow, maybe even open at the highs but then close at the lows. That would be probably worst case scenario, just running into earnings week next week. But even then, I gotta be honest, if that happens, we might sell off for I feel like we could sell off Wednesday, Thursday, and then rebound back on to Friday. So, I mean, net, I'm still bullish. I'm just torn. I don't really want to press a whole lot of bets here. I very much with you looking at Bitcoin. We've been on this setup for a very long time. It was super heavy, Coinbase, and I took some trims today, but not, still long a couple different ways. I'm legitimately long Conel shares still, but today, after today's move, the option premiums, they were just far outpacing the actual price action. So it didn't make sense to continue to hold the options specifically. So I did end up closing those, although, we'll see. I think it can get, I think it can still go higher. I just don't know if options are the best vehicle to trade that one at the moment. But yeah, I think the market looks constructive. It's possible that we're a little bit overheated though, coming into earnings. That said, there are still a lot of tickers that are looking decent for some bounce spots. So I'll go ahead and hold it there. If you can come around to me a little bit earlier, well, actually I have a second, so I'll wait for Evan to give his picks and then come at me after Evan.
If you need to go earlier, you can't go down unless you're able to stay on.
Just in case. Well, so I do have to jump in the car, so I may lose reception. But I will run it back with Conel, because I do think that definitely goes higher. I'm very much focused on what we call alt season. So if you're not sure what that is, alt season is the time where Bitcoin underperforms and all the altcoins outperform while the total market cap continues to grind higher in the crypto space. There's only one ticker definitively that captures them all. That is Coinbase. And I will press that bet again. I'm still long. I trimmed a little bit, not a huge amount today.
Paper, I trimmed a quarter. Baby. I'm holding.
I didn't even trim a quarter on the shares, but the near
I'm mad that you took my Conel though.
Well, so the near term options though, I fully closed. That was just that IV was just insanely juiced. But I do think it can have legs, but I will say it can be a little bit choppy. So just take that one with a grain of salt. The other one that is looking, so it was kind of a toss up between Nvidia and Apple. I'm not sure that either will win, to be completely fair, but just just because my boy Evan's on here and he's probably going to give some more picks, I'll go ahead and take the what's the 2x leverage Apple?
AAPX.
AAPX. Let's go ahead and run with that one. So I like Apple here for whatever reason. It looks like it's breaking out of its consolidation. In addition to Nvidia, who clearly already did and is starting to extend, Apple I think today looks like kind of like day one. So holding key levels over 230, that's super constructive to me. The consolidation break on Apple here is similar to the Bitcoin breakout, right? It could pull a little bit back, but I absolutely see this from a technical perspective going to 250 sooner than later. So AAPX and CONL.
Thank you. We'll go. Speaking of Evan, we'll go over to Evan. Evan, go ahead, man.
So I'm not a big market sentiment guy. Truthfully, all these traders, all these investors up here are significantly better than me. I'm the news guy for a reason. So I appreciate joining in and, listening to all the speakers up here. If any of you guys steal my pick for the week, I'm going to kill you. Not actually. Promise I will not do that. But yeah, don't take my pick. It's going to be the same one last week. You better not. Empty threat. Nothing will happen to you, but don't do it.
If they do, you could run with Hood, because that would be fun.
I could.
I'm very interested in this Hood event. Are you guys going to be there?
We're going to be there. I'm excited. That's actually why we're doing the space where we're going there.
Are you going to live stream it?
I think I will be live streaming. Yes.
Okay. Is it on your YouTube? You got to let us know where to watch, because
I might do it on X. We'll see.
Yeah, I need to watch. I'm excited. It's a big event, man. Big event.
The keynote is 6:30 p.m. Eastern on Wednesday, so keep an eye out for that one. And then the demos, I think, will be Thursday. I don't know, though.
Very exciting.
All right. We'll keep moving it around, then we'll go over to Nick. Nick, go ahead, man.
All right. I'm basically in line with Paper Gains. Overall, I really like how some of these weekly bases look. Just taking a look at the NASDAQ Qs, we've been consolidating in this base since, July 10th we put in the high. So a 3-month base that we're just getting up to the new highs right now. That to me doesn't scream it's time to sell everything and run. You see the large cup and handle in Bitcoin right up against that downtrend line where we can start to get volatile again, hopefully to the upside. And Nvidia, new closing highs. The software IGV ETF broke out of a massive monthly base last week, is still acting well. So while we might be a little overcooked in the short term, and maybe this week, if you pick longs, we have a pullback, but overall, I don't want to risk having I don't want to sell everything so I don't have a 1 or 2, even maybe a 3-day kind of pullback in my account, versus totally missing the larger picture of all of these quality bases breaking to the upside. So for now, I'm still pretty heavily long, but I'm ready to get hurt for this week to hopefully profit over the next couple weeks, because like Paper Gains pointed out, that Apple base looks great. QQQ base looks great. And even when we take a look at like ARK-K, it's finally above all the key moving averages. Kind of looks like a launchpad setup where we really haven't had many of those. I don't want to call them crappy stocks. I'll just say like high volatility, high beta stocks, like 2021 type leaders. We haven't had those like massively squeeze. Whenever you have kind of like the end of the run, or at least like the short-term run, you tend to see like solar stocks breaking out and squeezing higher. And none of those stocks are doing that just yet. So that's kind of going to be my sell signal or take my foot off the gas. But until we get like a really crazy extension to the upside, I'm still going to be kind of thinking long-term on the long side.
Awesome, man. We'll go over to Story Trading. Go ahead, man.
All right, great. Sorry to kill your format, but I got a meeting at 5:30, so I got to give my picks during this segment. Sentiment-wise, look, I've actually been pretty surprised here with the rally we got after CPI, PPI. CPI was a little hot. PPI was in line, maybe a little bit light. And going into October, I lightened my long positions from close to 100% to about 85%, because I thought between the Israel situation and maybe the CPI, PPI, that could be a catalyst to finally get some of that seasonality in October in an election year, which we haven't had yet. So I've missed a little bit of this rally, being 85% long instead of 100% long. And unfortunately, so some of the things I sold were Hims, Hood, SoFi, Palantir, great stocks, which really exploded the last couple of days. But I worry, man. Geopolitically, the situation I think is really not stable. Not just with Israel, Iran, but China encircling Taiwan, North Korea, South Korea. There's a lot of stuff going on, and also this election situation is crazy. I don't know if you just saw it, but Biden put out here, it says U.S. President Joe Biden has instructed his National Security Council to make it clear to Iran that an assassination attempt against former President Trump would be seen as an act of war. So this stuff makes me nervous. And I know, like, the charts look great, everything looks great, and if we didn't have the election and the geopolitics, I'd probably be 100% long right now. But I have some hedge. I've been playing some hedge actually successfully with gold calls. USO calls as well has worked out. I've steered clear of it today. So a big spike down in after hours on USO, because apparently Netanyahu told United States that they're not going to attack the oil facilities. But so kind of like sentiment from big picture, yeah, everything looks good from a chart perspective. But this, I just can't be all in because of all the geopolitical situations going on. I can't ignore it. So yeah, I got some cash, got a little bit of hedge, and we'll see what happens. So a little bit unsettling for me. But as far as the picks here, all right, one of them is going to be uranium related. Now, we put an alert out right when some news hit. The news was Google. This came out like at 3:30 or something, maybe 3 p.m. Google backs new small nuclear reactors, something like 6 or 7 nuclear reactors to power AI. And this comes on the heels of, I think it was Microsoft and Constellation Energy a week or two ago. So things are really, really coming together. Uranium's a core holding of mine in the long term. And everything that's been promised for uranium is happening exactly as all the uranium bulls have envisioned. And this is a situation where, in my mind, 1 + 1 doesn't equal 2; it equals 3. And what I mean by that is you get that Constellation Energy deal, and now you get this Google one. This is it's no longer just fundamentals. It's no longer just a quantitative thing to say, okay, whoever may be doing that math out there of, all right, we got this Google deal, we got the Microsoft deal. Now you have to add sentiment premium to that. When you have 2 consecutive deals of mega cap companies saying we're going towards nuclear to power AI and energy needs, that's going to start building in a sentiment premium in the space. So we put out a buy alert on Oklo, OKLO, at $9.50. Like, what is it? Like 2 hours ago. It's already $10.50, and if I could, I would even pick this right here, right now. The problem is with our competition, it goes by the opening price tomorrow morning. I have an 11.29 target on it. So what I'm going to do is go URA, which is a uranium ETF. URA. I have a different uranium ETF. A URNM is my core holding, but URA, a different ETF I discovered recently, which is more liquid than URNM. So URA is going to be the first pick on that. And actually, let me just take a peek at that chart on URA. You can see recently we're at 30.37 after that Constellation Energy deal. Maybe this thing can swing up to its recent high in May 24th. Maybe it can make a move to that 33.63. Got to get past like 31.50 first. But in any case, yeah, Oklo I kind of like better for right now. Here in after hours we're playing it, but for competition purposes, URA is not going to have this big gap open tomorrow morning that Oklo is having, up 5% already in after hours. All right, that'll be the first pick. Second pick is one that's already ran. I almost contemplated giving this to you guys last week. Last week we gave you Air, which worked out well, up 24%. The second one was Oxy, which was down 1.5%. The third one that I almost picked last week for you was Geo. We did give this to our community, GEO, Jaguar. I hope I'm not stealing your pick. But GEO, I don't know how much meat is left on this bone here, but look, DJT, Donald J. Trump stock, exploded since last Monday morning. We had this on our show. Last Monday morning, we had a little session on looking at the odds of who's going to win the election, and things just exploded for Trump after Elon Musk came out full force for Trump, and all the quote unquote Trump stocks started moving last Monday. DJT up like 100% since then. Now, we didn't play that because it doesn't have good fundamentals at all, so we chose Geo. Much better fundamentals Trump play, and that's been working great for us along both the stock and some options. Maybe this has more meat on the bone, Geo, because it seems like Trump's momentum is only picking up, and all of the poll data and the betting data that's coming out, that's the immigration stock, border enforcement stock with some detention facilities. Maybe Jaguar might want to chime in more on that later. So those are the two picks for you. Oh, technically speaking, GEO, let's see how far can this maybe go. Got some interesting candle resistance, maybe 1560 or so. We're at 1480 now, so maybe not a lot of meat on the bones left, but who knows? Maybe we'll get a little short squeeze and send it over 1660 or something. Those are my two picks, URA and GEO.
Awesome, man. Thank you. We'll go over to BK at Luxelga.
Hello. All right. So we this week we went short yin, and on the China extension there. Still want to keep an eye on China, but now that we've set a range over the past week, technically speaking, we want to see which side that's going to go. Not trying to predict it, so reacting. But some interesting headlines still coming out of there. Bitcoin, of course, is really exciting. I mean, BlackRock gave some very positive commentary on their earnings call with it, especially regardless, noting that it would go up essentially regardless of who won the election. I doubt, it's going to be as big as the housing market in the next 4 years, no matter what. But it was a nice sentiment driver there, and we did see a lot of momentum here. So very excited. Crypto space, I think that's getting some momentum with Bitcoin coming back. Really watching China. I think we're probably safe for another week. I think October surprise will probably be hitting later in October. Was looking at dates at previous October surprises, and they all hit in the late 20s, around the 28th, closer to the election. So hopefully with all-time highs, we get a little more momentum and excitement before markets start reacting possibly to that. That's what I got.
Awesome. We'll go over to Michael.
Wait,
Michael, go ahead, man.
Before the algo man jumps in, speaking of algos, just because I wanted to sandwich this between Lux Algo and Michael Nasalgo there, and just wanted to point out real quick. First of all, a big shout out to everyone that's up here on stage. We got the full crew, and I just wanted to repeat for those because not everyone was in here at the beginning. This whole crew, everyone made 2 picks, and the average all picks was over 7% return in 1 week. If you, calculated that out over the course of a year, that's a large percent return. Now, I'm not saying we're going to do that every week, but I think it shows the immense power and skill on this panel. So first off, you'd be following everyone on this panel. They are killing it. Everyone has different ways that they make their picks. One of the ways that I've recently been making picks, and I won, just as a reminder, 3 weeks ago, is I've been using a lot of these Lux Algo, different algos and indicators that they have. And they actually made this awesome video today because I don't think a lot of people understand market structure, right? Like a bearish change, a bullish change.
The one I just posted too. I love that, dude.
It's really good, right?
Yeah. I'm positive, Gav. I think it's so timely because I think we might get some of that this week.
Ooh, foreshadowing. But yeah, I just recommend. Oh, by the way, shout out to Raj in the audience. Don't know if you saw that there, Sam. The homie Raj. Gotta love it. I'm following him. Nice. So what's it called? With that being said, and by the way, I should also change the title of the space because I forgot to update that. But yeah, just wanted to say if you haven't checked it out yet, the market structure breakdown is in the top of the space. There's a great video, and I think you're just missing out, to be honest, if you don't see it. BK, maybe you can just add color to that for 1 second, what people are seeing, and then we'll go to Michael Naus.
Yeah, I mean it's starting to use like indicators to help decide where your supports and resistance are, and then to have some context. So you're setting the rules and looking at the larger structure rather than just one line.
Hey, we'll go over.
Did you cut out? Yeah, you cut out for a sec.
Yep, sorry. So, yeah, I've been to add color to that. It's kind of just
company's called DataShop.
Can you hear me?
Yeah,
we can hear you.
Okay. Yeah, to bring in the.
I don't know what's happening. I'm getting unmuted and stuff.
It seems a little shoddy.
Yeah, I keep getting muted.
Oh, there's some weird spaces glitch happening. I don't know what's happening.
All right.
Damn it, Jordy, fix the wires. No, I'm just kidding. I don't know what's happening. It keeps muting you. It keeps unmuting me. I'm gonna drop down and come back up. BK, you should probably do the same, and then we'll continue with this. But for Michael Naus, you want to jump in for now?
Yeah, sure thing. Market sentiment being fairly straightforward. The market's making new all-time highs. You can't really be super bearish when that's happening. But like everyone mentioned, we are in a seasonally choppy time, so I think we need to be a little bit careful about that. But when we see Bitcoin running, just any Bitcoin maximalist, close your ears for a second. But Bitcoin's a risk asset. It responds very well when people want to take risky bets, and it sells off when people don't. So I've been using it for a while now as kind of my canary in the coal mine for what's happening there. And we had a massive rip over the weekend and last night into today in Bitcoin. So markets hitting new all-time highs. There's evidence out there that people are taking on more risk appetite. That's obviously going to be a good thing. So now it's just are we going to enter that choppy season? I continue to be in this kind of buy the dip mode that's been working out. Haven't really been selling the rip because we've just been grinding new all-time highs. But again, that election coming is the only thing that's worrying me. If this price action was just existing in space without needing to care about your guys's the Yankee election going on there in a few weeks, yeah, I would just say, hey, we're ripping all new all-time highs, all lights are on, away you go. However, the one thing I do want to bring up is that after the election, generally speaking, that's bullish time if you really study the seasonality, right? Again, it doesn't matter who wins. We usually get a move into the end of the year higher and then in the beginning of next year as well. So I don't know if the market's maybe front running at this time, but certainly nothing technically I can see to be bearish. It's only the seasonality that has me a little bit more cautious.
Awesome. Hey, Sam, you want to try dropping me co-host once more?
Yeah, it says there's already 2 co-hosts. I don't know who else. I don't know who else is co-host.
So I gotta run. Just want to point out that Oklo OKLO just hit our 1129 target. So whoever got in, congrats. Time to ring the bell. I'll see you guys next week.
Thank you, Ben. Okay, and BK, let's see if it mutes you again. You want to try to finish that thought on market structure, then we will keep going up here?
Sure, yeah. It's just a small support resistance indicator that, helps keep in mind that although, the line in the sand that you have on your chart may be broken, there's a reminder to always be looking both out and keep zooming out until, you've set your rules, whether it's bullish or bearish structure and whether you want to remain long or short. Regardless of your shorter zoomed in lines, you a good reminder to always zoom out and change your time frames.
Beautiful. Make sure you guys are following Luxalgo. They're killing the game, especially when it comes to indicators and all that good stuff. And a lot of us use them for making our picks. Okay, I'll turn it back to you, Sam, to keep it rolling.
All right. We'll go over to Jordan. We haven't heard much from Jordan yet. Jordan, are you back from the store?
I am here. Can you hear me okay?
We got you.
All right. Sounds good. Well, I know most of this panel is feeling very bullish. Hard to disagree. I mean, you keep looking at that SPY daily. I feel like it's boring at this point that we're coming on and it's like, yeah, we're all bullish still because it's just like, I mean, at the end of the day, you look at the chart, it's up and to the right, higher highs, higher lows. I'm in agreement with the panel here. I don't know how you can see anything bearish here chart wise, except for, you know, whatever fundamentals or seasonality may be going on, which I totally understand. But, you know, if you tried to get short based off seasonality from last month, I mean, you didn't do very good, right? Things came back pretty strong at the end of the month. And I just think positioning yourself solely off of something like seasonality or some data point is it could be detrimental to your account, right? So I think always making sure that price action is following your analysis on whatever internals you're thinking about the market could do. You know what I mean? Just making sure price action always lines up with that at the end of the day, because price action never lies. And I mean, this whole year, even I would never advocate for this, but I mean, even if you were buying at every all-time high instead of the dips, you're still doing significantly well. It just goes to show how strong this market is. And until, again, I see, you know, some lower highs, lower lows, actual market structure changing, and this bullish structure breaking, I'm not going to go that way. I have been taking some shorts intraday, scalping the futures around. Happy to take intraday shorts because we all know how intraday price action can be. It just, you could play that stuff back and forth. But in terms of swings, I have not swung short in a long time, and I don't plan to until I actually have a reason. And I don't yet. So we're still swinging long. Shout out Paper. Got my eyes on coin a little while back, and we've been riding that. Had a pretty big day on coin today. We're gonna see if we can keep it going. But looking beautiful on the charts. I don't see a reason to be bearish here. And I think, you know, if you do have that thought, maybe just wait till that price action starts to align with your thesis a little bit, in my opinion, and might save yourself some money. But, you know, everybody's style is different, so I understand all the thoughts out there. But charts are looking beautiful, so let's keep it going.
Love to hear it. We'll go over to Nick. Go ahead, Nick.
For stock picks?
Yes, sir. I think everyone up here is kind of giving their sentiment. So, yeah, go ahead, man.
Well, yeah. Well, okay, so we got a little bit mixed up here, and maybe my fault. A lot of people did their stock picks earlier. Some didn't. Nick, if you would just want to give market sentiment first, then I think we still have stock picks coming from you and Michael Naus, Jaguar, and Jordan and Evan. So I think you can start with market sentiment, then we can come back around for that. We have time.
I gave a market sentiment a little bit earlier.
Oh, okay. Well, if you did get yours in, and apologies. Sam's hosting because I am currently about to walk into an Uber, so I've not been as closely paying attention. Then yes, stock picks it is.
All right. First pick I'm going to go with is QFIN. This is a Chinese stock that actually started to break out and started its uptrend well before like the rest of the Chinese stocks did. And that's always something that I try to key in on. What are the stocks that are making new highs before the indexes are making new highs, or before the ETF that aligns with a theme is making new highs? And outside of that, you can see a lot of the Chinese stocks have gapped down and really kind of stayed down for the last couple days. But QFIN had maybe never even went below the 20-day EMA, but undercut the 10-day just twice, never closed below it, and is trading above all the key moving averages. So what I'm looking for here is if we get KWeb, like Chinese internet, to have a gap down or like a quick sell-off to the 20-day moving average, I'm hoping what we'll get with QFIN is another test of that 10-day EMA right around 3170. And then that would be my entry versus the pullback low, which would be right at $30. And the 20-day EMA is right around there as well. So kind of two protective areas before my stop. And if we get that like kind of final flush before a snapback rally in KWeb, then we should be pretty well positioned in QFIN, because that has not been pulling back at all. I think within, let's see, about 1% off its highs, while the rest of the Chinese names are down quite a bit more. So great strength right there. QFIN is my first long. And my second long, I'm just going to run back ASTS. This is a stock that rallied, I want to say it was like 1,500% in 20 weeks or so. Since then, pulled back 45%. We're starting to see a higher low put in last week. We just pushed through the 5-10-day EMAs today. We closed right on the 20-day. So if we get kind of I don't want to call it a final push, but a shift from quality stocks and quality growth to more of those speculative assets with Bitcoin and some of the like very, very fast moving stocks before we get a correction, then ASTS should have that fits that profile of stocks that can generate very large alpha in a very short amount of time. So ASTS and QFIN both on the long side.
Awesome, man. We'll go, since we're kind of going through the stock picks now, we'll go over to Evan, and then we'll keep moving forward. Evan, go ahead, man.
Do I run it back again, or do we go different?
I think you run it back again, Evan.
All right, good enough for me. MSTU long, and then I'm going to go short MSTZ. 1% of my head was like, all right, am I about to go long MSTZ and short MSTU? But not quite yet. We'll see. We'll let that come to me. We'll as Jordan was saying, the charts are still kind of looking like this, so I won't try and preempt it. But I'm setting myself up to either come first and last in these competitions, and we'll see. MSTU long, which is a 2x long MicroStrategy ETF. Short MSTZ, which is a 2x short MicroStrategy ETF. So I'm basically getting double 2x long MicroStrategy twice.
Awesome, man. We'll go over to Jaguar for your stock picks. Go ahead, man.
All right, let's do this. Number one, Intuitive Surgical, ISRG. It will report earnings on Thursday, this coming Thursday, before market opens. And actually, let me just check on that. No, I'm wrong about that. After market close. Intuitive Surgical will report earnings on Thursday after market close. I expect this company to report a blockbuster quarter. The stock has been consolidating in a tight range between 475 and 490. I expect this to break out and make a run over $500 per share. And here's why. In case if anybody has been following the story, DaVinci 5 launch was a massive launch for the company, which was originally announced in December 2023. And then it took a little bit time to get it off the ground. And now we have seen some progress around that. The American College of Healthcare Executives, a magazine for healthcare leaders that provides focused coverage for emerging trends in healthcare management, late September published an article with very early data showing better profit contribution on Intuitive Surgical's new DaVinci 5 robot. So get this, just how easy selling point this is for Intuitive Surgical to hospitals. This article is highlighting that DaVinci 5 is 15% less operative time, takes 15% less operating time, and results in 10% direct cost savings in a single surgeon's early experience utilizing the technology in just one sort of procedures, which is cholecystectomy. I guess I chew that word pretty badly. Procedure. The total contribution margin per day on DV5 or DaVinci 5 was $21,308 versus $14,619 for the prior system called DaVinci 4. This is a difference of $6,689 more contribution margin per day. And this is precisely what the selling point. If you assume 250 days per year, when the machine is being used in hospital, this would equate to over $1.4 million more profit to a hospital on DaVinci 5 system over a course of a single year. And when you compare that to the price of DaVinci 5, which is less than $1 million above the prior system, it becomes an incredibly strong selling proposition, according to this journal. And I think the company is using this very basis to sell it to the hospitals. We saw a little bit of an uptick the last time when the company reported earnings and its procedural growth in DaVinci 5. I expect this time this particular growth to accelerate, and we should see this in the numbers when the company reports earnings on Thursday after market close. So the first pick is Long Intuitive Surgical into earnings. The second stock is going to be Equifax, symbol EFX. This is, as you all know, this is the company that provides, this is one of the three companies that provides, so credit reports to consumers and businesses, mostly to consumers. Equifax will be reporting earnings this week as well. And let me check. That's actually on Wednesday. That is October 16, Wednesday after market close. I expect this report to be stronger than expected as well. And here's why. This company issued a really lowball guidance back in middle of July when they provided the guidance for the second half. Why? Because they were not entirely sure as to where the trajectory of the Federal Reserve's cuts was going to be. Remember, there was a lot of back and forth between, it's going to be 25 basis points or 50 basis points of cut. On top of that, the timing of that was also question mark. So companies that are directly impacted by mortgage rates, and that's what Equifax basically sees a high 92% correlation with the refinancing activity in the country. They weren't sure exactly back in the middle of July when they were announcing third quarter and second half of 2024 guidance as to what to expect. Well, they actually they guided to a 7% decline in the number of inquiries that they expected in the third quarter of 2024. But according to a website called optimalblue.com, which feeds into the MBA mortgage application tracker for mortgage rate locks, it is pointing to a 10% year-over-year growth in the third quarter of 2024 versus the company guided to a 7% decline in the number of inquiries. That's a very big delta of 17%. So I believe that the street is expecting bad numbers, and they're going to blow those numbers out of water with a very strong number and should guide higher as well when they report earnings this Wednesday after market close, and that is Equifax. Mind you, this data that I'm quoting from optimalblue.com, it is 92% correlated with Equifax sales, or I should say vice versa. Equifax sales are 92% correlated to this data. The point being, we should see a nice, easy, clean beat from Equifax because the refinancing activity has sharply picked up since the Fed cut rates about on September 18. So good quarter in as well as good guidance from Equifax. Let's see in that scenario if the stock can bust through $305 to $310 per share and make a new 52-week high versus the stock currently at $291. That's my second pick. So again, long Intuitive Surgical and long Equifax, EFX, going into earnings. Both are reporting this week. Thank you for having me.
Awesome, man. I think we just got a couple more people for their stock picks. We'll go over to BK at Luxelgo, and then we'll go to our final two. Go ahead, man.
All right. So, a little riding this risk on Bitcoin excitement. My two picks are going to be around that. Someone already took Connell. I think that was paper.
It's all right. You can take ETHU. That one's still available.
I think I got my alts. Running my backup here is Mara, first pick. Bitcoin miner, holds one of the largest public companies holding Bitcoin. And second option there is going to be BTCL. So leveraged long Bitcoin. I believe that's a 2x from T-Rex there. And Mara, the Bitcoin miner and Bitcoin holder. MARA.
You got it, man. You said Mara was your first one? Mara?
Yep.
You got it. We'll go over to Jordan. Jordan, go ahead, man.
Alrighty. Well, TSLT did not do me very good last week, so I'm gonna run that back though. I love this dip off the Robotaxi event. I'm actually not long it yet in options. The IV is still a little high for me. So I'm trying to wait and let that flush out a little bit and get a little better there. But I love the chart. It's just for me, the IV right now is not it's not horrible, but it's not great. For me, it's like not quite worth the squeeze. So I'm trying to wait and see if I can get that flushed out a little bit. But I mean, holding this higher low structure on Tesla, obviously that was a nasty candle after the Robotaxi event. No lie, I definitely got smoked a little bit on that. I was long into that, but I've also been long since that August bottom, right? So we've done well on the way up and took the loss there. Thankfully, Coin is covering all that on the options trades lately. That thing has been ripping. So I'm going to run it back TSLT long. And then I'm going to go AAPB, which is the 2x leverage Apple. Apple's been in this weekly consolidation for a while. I mean, I think it breaks to the upside given the impulsive bullish trend we've been in with this beautiful weekly consolidation. But at the end of the day, I just don't know when, right? It doesn't have to happen this week. I would love for it, especially for the contest. And it's looking good. It's looking like it could try, but I don't know for sure. So we're going to try with that. I'm not actually long either of these names right now. I'm just long Coinbase, Microsoft, and Google, but looking to actually get long Tesla as well. Probably not touching Apple right this second, but in my real account. But we're going to try it for the contest, so that's what I'm rolling with. 2x leverage Apple, AAPB long, and TSLT long, 2x leverage Tesla.
If I'm not wrong,
Awesome, man.
I'm not wrong, Paper already took AAPB.
It's fine.
Wait, did he?
Give it to Jordy.
No, it's okay. It's okay. I have another name. I didn't realize.
No, it's all good. I am long Apple. Side note, November 15th.
Are you sure? I can switch. I got other names.
No, because I was trying to DM you to take this. So take it. I think it's great.
Okay.
I'm long the stock heavily. I'm long options for November 15th. But I don't know. I'm getting a little FOMO, guys. I'm just saying it's possible. I would like to.
So what are you taking in transfer for that? What are you gonna grab?
ETHU. Since nobody picked it, I don't think that people really know about this ticker, but ETHU. I'm just, if it wasn't for AVAX, Michael Naus might even pick AVAX. You never know. But I'm gonna go ETHU then, and I'll swap it for the Apple 2X, and Jordy can have the Apple 2X.
Thanks, Paper.
Yeah, they're both good though. I'm just gonna ride. I'm gonna ride with Evan. So either we continue to go up to the upside, or we get absolutely demolished.
Let's go Apple
this week with an epic pullback.
Awesome, guys. I think we just have Michael left, if I'm not mistaken. So, Michael, go ahead, man.
Saving the best for last.
Don't forget, our Avalanche is available.
I have no idea what that stock is. In fact, I don't know what any stock I trade is.
It's crypto.
Oh, crypto.
You don't remember?
Yeah.
AVAX. Yeah, baby.
Yeah, I'm more buying dips and selling rips in this. So that I own a bunch of crypto. So I hope that rips, of course. I own a bunch of MSTR as well. But yeah, the algos. Again, my job is not to pick stocks. My job is to pick which algorithms I think are going to work the best, and then kind of let those algorithms pick what stocks to trade. So more focused just because of the whole election thing going on buying dips, selling rips, mean reversion algorithm. That's part of Stats Edge Pro. You can check out in my bio, my website there. So again, I don't know what these guys do. I don't really care too much, right? All I know is that I have data going back to 1980 to prove if I trade these in the way the algorithm says to trade it, I'll do fine in the long run. So that's kind of where I'm focused more than anything. So first one is LRN, Stride Inc. Down like 1, 2, 3, 4, 5, 6, like 10 days in a row, all the way down close to the 200-day moving average. This is the mean reversion algorithm that is working out very, very well. I think the both picks from it last week were like 15% each. And $70 seems to be a huge area that it broke out of a long time ago. So, we're looking for about a week play. We're looking for a little bit of a pop, not to get married to this thing or make it go back to all-time highs or anything like that. Just to see. Now, for me personally, I would probably get out if we had a close below that 200-day moving average. The algorithm has a stop in it, but it's just a little complex to explain on air. It uses average true range. But yeah, so if it pulls back to this $70, that's probably where I'll get involved. Any close below that 200-day moving average, time to go. 14% short float, nothing too wild. And then the only other thing to note is it has earnings in 6 days. For me, I know some people like to speculate on earnings. I don't, just because I don't have a system that I can point to with that much data to prove that I have any edge there at all. So I just avoid that. So it's saying the 22nd after market close is earnings. Just be a little careful if you're planning on holding that to the long run. But yeah, the monthly chart on this one's insane. It's gone from $20 to 85, 90 over the last few years. And yeah, so when it makes a sharp downturn like this, sometimes these are good little dips to get. Now, I think it was Nick that was talking about ASTX. That was going to be one. So that one looks good as well. That one came from one of the breakout systems. But I'm going to go with Rackspace RXT. This must be. It's got to be some sort of corporate action or reverse split or something.
Data center.
Data center. Yeah, I'm seeing 12 days to cover on this name. That seems pretty wild to me. So I thought there might be a corporate action that's messing with the short data. For those who don't know, days to cover is just the amount of shares held outstanding short divided by the average volume. So it just shows that if shorts had to get out of the position, it's going to take them 12 days to get out. And this one can be pretty volatile. So there is a chance for a short squeeze. Had a nice little push up from, I think, 175 or so to almost like 280 or so over the last number of weeks. Now it's pulling back to 250. If it holds this 250, I really like the look of that to push higher. If it gets going, we've got that short float that could get things going. It's only 10% of the shares outstanding, but again, I like that days to cover number more, just because it shows us that, hey, yeah, these guys, if they have to go, because it's not a super liquid security, they're gonna have to hit that hard. So fairly low float, right? 89 million shares in the float and only 600 million share in market cap. So just FYI, you got to be careful when you play lower float. Lower cap is a double-edged sword. If you're right, you're going to be really, really right, and if you're wrong, you can have a bad time. But yeah, so that's RXT and LRN.
And are you long or short on those?
Long on both.
Awesome, man. I think that was everyone. I have everyone logged in.
Did anyone take Netflix, which is reporting Thursday after market close?
I don't think so. Did anybody take Netflix? If I'm not mistaken.
Wow,
What was the question, sorry?
You almost hate Netflix. Netflix reports on Thursday after market close, and nobody took it. I find that very interesting. Probably for good reasons, to be honest with you, because my channel checks are not all that very strong either. So probably see a dip in Netflix after earnings. But I was just curious.
I don't think anybody took Netflix. Does anybody have any final thoughts before we kind of wrap this space up?
Gav just texted me and said he is throwing Celsius into the mix for his pick.
I feel like if you're going to make things up, you should make things up that are non-believable.
I'm just saying he just texted me CELH long for Wolfie.
Gav, do we usually hear picks from you?
I can throw in some picks. Did Evan already take MSTU?
He did.
Did he take short MSTZ?
He did.
Okay. Let's see. Hmm. Let's take this other stock that I was looking at earlier today. I think it's BKHD. Let me see. I was looking at this one earlier today. Let me find this. Actually, you know what? I take it back. Put me down for meta long, actually double leverage meta long. So FBL, which is double leverage meta. Did anyone take that? BK, did you take that?
Nope.
Okay, put me down for double leverage meta long, which is FBL. And then put me down for, let me see. Put me down for NU Holdings. That thing's been going crazy lately. This is a Kim stock. Kim put it on my radar, and it's been really doing very nice. And it came out of a big dip in the last month, and it almost broke even. So I kind of like how this one's looking. So yeah, those put me down for those two.
Awesome, guys. Well, it's great to talk to everyone up on stage. It's a pleasure to be here. Be sure you're following everyone up on the panel. Like Gav said, the average was we were up 7%. So these guys do know what they're talking about. So be sure you're following all those guys. Be sure you're checking out Lux Elgo, our co-host. But overall, guys, this was a great space. If anybody doesn't have any final thoughts, I'll close the space up. Lux Elgo, you have any final thoughts?
No. We do have another space after this. We're going to keep this open.
Oh, never mind,
not
guys.
Closing this one. Yeah, with this space, we're actually going to be open on for a little while now.
Here, final thoughts though. If we do get a dip, I found an old graphic, but it's just a diagram of a potential election dip, then rip. But that is historically what it looks like, just in case anybody was wondering.
Sam, it still doesn't let you send me codes, does it?
It does not. There's
Okay, no worries. Okay, you're good. A few people are going to be staying on with us. Jaguar's staying on. We have a few more people that are popping in here in the next 5 to 10 minutes. We are going to be doing a little 40-minute thing here on long-term investing. So if you want to change the title to long-term investing with just capitals on each word, that would be perfect. And Jaguar, I'm actually going to roll right into it with you since we do have the stock picks in. That's obviously just for the week and it's a little shorter term. But I think people at this point are still filling out, their long-term investments, their retirement accounts, all that good stuff. And I'd love to hear from you some information here on what your approach has been lately to long-term investing, how it differs in your mindset when you're picking for, a short-term pick versus long-term, all that good stuff.
Yeah, sure. For me, the easiest way to build a strong portfolio of high growth companies that can reasonably outperform the market is finding compounders that are pulling back to important supports. And I know it's easier said than done, but there are opportunities like this all the time that's in front of you. And I'll give you some hard examples. You know that, for example, we have talked about multiple times that a company like Kratos Defense, KTOS, is the best of breed drone maker in the country. And if you simply just look into the warfares and combats that are taking place between Russia and Ukraine, or even between the threat between Israel and Iran and other parts, they're all being fought by drones. There are no humans involved to the extent that you would have seen in the past, right? I mean, in fact, I have a detailed analysis of the last year of all the major combats that took place in different parts between Russia and Ukraine, and you will find out just how much drone systems have been used in these warfares. And the best of breed for that in the United States is Kratos Defense. Any time when that company is going to pull back, it's a compounder, double-digit percentage compounder of the top line sales with a very large book and growing book of contracts. Anytime when that thing is going to pull back, it's simply going to present you a buying opportunity. And that's precisely how I approach it, where my simple way of running a long term portfolio, such as my IRA, has always been, I hold a core position in my favorite names, and then I, run a bandwagon around it, basically turning the the volatility to my advantage. And what I mean by that is, for example, I would always hold, for example, the 50% of the desired position in that stock, and then just add anytime when it pulls back 5 to 10%, I would add it on that dip. And anytime so when it goes right back up, I will sell the very dip that I bought. Constantly running bandwagon around it. 5% usually is my threshold. Now, what this does is, because I'm constantly adding and constantly selling, the rental that I'm taking while always holding the core position, my average cost on that stock will always go higher over time, even though I would be holding my core position for a long period of time. And that's always the case in my portfolio. But this allows me to stay engaged with the volatility and turning it in my favor. You're probably going to get a lot of volatility, stupid volatility, because of I should say dumpster fire politic that will happen after the elections. You may see some very good names just come down 5-10% for really no good reasons. That's where you should be prepared to buy those dips in those long-term compounders. Kratos defense is one of them. We've talked about this many times. Boston Scientific, BSX is another one. Embraer, which I've been vocal on, saying multiple times on Spaces and on Twitter. That is symbol ERJ. This company is the first company ever in our lifetime that is going to break the duopoly of Boeing and Airbus, and particularly it's going to disrupt Boeing, and I believe in that, and it's going to do so not only in the commercial side but to a certain extent on the military side as well. We are waiting for Embraer ERJ to announce a very large order for C390 planes from India. The similar type of order that they have been getting from other parts of the world. That's the military jet. And there have been contemplations around this that it could be as much as $4 to $5 billion order initially that could rise substantially from there. To give you some context, that would be 2 times the number of the entire order book that they have. And it's coming at some particular point. That's just on the military side. And then on the commercial side of things, if you simply compare the delivery forecast, I mean, these companies publish that data right on their website. If you simply look at the trends of the deliveries of Embraer jets and compare that to Airbus or Boeing, you'll see for yourself exactly how strong the trends have been in the company's favor. And so I have been vocal on multiple times saying that this is a stock that's going to $100 per share. Use any pullbacks you get, of 5 or 10% pullbacks you get, to basically buy the dip. Well, you're getting the very pullback right now in Embraer, ERJ, which was as high as 36, 37, pullback to 33. That's precisely the pullback we're talking about. And that's what I did just this morning. I bought the dip on ERJ while always holding the core position. I expect this stock to go right back towards $40 per share in time. So names like these are long-term compounders because they are uniquely positioned to either disrupt the prior status quo in whatever industry they might be in, or they may be simply benefiting from the strong new emerging trends that are in front of us, such as drone technology and all of that. You can find those kind of ideas in tech or whatever favorite sector you may have. Use those pullbacks on silly pullbacks that happen for no good reason but outside noise to add in during those dips, while always holding a core position, and then trim those as these stocks go right back towards new 52-week high. That's how I approach the market. I gave you guys a couple names. I can always come around later and talk about a few more.
Awesome. I'll swing it over to Evan. Evan, go ahead, man.
Yeah, no, I appreciate Jaguar's thoughts as always. And I definitely do agree with a lot of his sentiment. My favorite thing that Jaguar does is he always comes here with like the play, but also kind of the thinking behind it. So, and like the thesis and everything like that. So I'm a fan of Jaguar. my long-term investing style, you guys know, I believe in broad-based market indexes. I really do. It's very possible to beat the market in the long term picking individual stocks, and I don't want to take away from people, but I also think you don't need to make it harder than it has to be. And maybe 60% of your portfolio is picking individual stocks and 40% is indexes. For me, it's closer to like 70% broad-based market index is a goal and 20% individual stocks. But I think there's the spectrum for everyone, and you know the way I like to kind of push people is like 99.99% of market participants or people who are doing stuff, maybe not that high, but I think 95% of those market participants really should just be in those broad-based indexes. And I really do believe there's a spot for that type of thing in everyone's portfolio. So I am actually also about to be going to the airport here, so I don't have too much time to kind of go in depth into it and share some thoughts there. But my background kind of like it's a strong word to say I was a financial advisor before this, but I was there for a couple weeks and I passed all the tests. So technically I am as qualified or was as qualified as any other.
Maybe like a financial suggester.
But yeah, no, but yeah, so I passed all the exams and stuff like that. And that also, I think, kind of informs a lot of my viewpoints here and that like, it's great. People are going to outperform me years and I love to see my friends doing great in the years. But, my goal here is to compound something over decades, and I'm okay to not come in and get some crazy returns every single year in favor of creating something that's more long-term and stable. So that's the way I kind of look at it. There's a lot of different places and ways that people can do it. It is definitely possible to beat the market, the S&P 500 consistently over time. I mean, Warren Buffett, but it's very difficult. And I think sometimes people come in and think it's easier than it is and don't show their respect to the market and to picking stocks and whatever. And you're gonna fuck around and find out is how that tends to go. So I respect the market. I respect that I have time in the day about and choose how I spend it, and I invest according to how much time I have to do the research into these plays and where. That's how I invest. Maybe a little bit of a ramble there, but yeah, that's pre-airport, Evan.
Well, thank you, Evan. Have a safe flight. Have fun in Miami. We'll go over to Jeff. Jeff, go ahead, man.
Hey, what's up? So, we got this book on long-term investing. It's called Stock Traders Almanac. The 25 edition, the 58th edition is hitting the warehouse. We should have some soon. But the core long-term technique, methodology, strategy there is really based upon cycles, patterns, seasonals. But we do overlay that with fundamentals and technical analysis. And if you look at the history of the best month switching strategy, it beats the market with 2 simple trades a year. It's also a mindset that you don't want to be, getting into long positions in the spring, April, May, when the market's up, and you want to be looking to get into these October sell-offs. This year, we're not really having one. Everyone's going to come out and beat up the best months and have at it because that just makes it work over the long haul, because it doesn't work 100% of the time. Nothing works 100% of the time. I don't work 100% of the time. I'm sure Wolf doesn't. I'm sure Jaguar doesn't. Evan doesn't. I think Evan's going to be in a flight, not working for a little bit. So, but the point being is that, you got to learn from your investment mistakes. You got to let your winners ride, sell your losers short. Stocks, as Jaguar was saying, picked out a couple of, very sound plays there. I like what he's thinking there. I don't necessarily dig into the stories as much anymore. I get my stock picks from the numbers. We run a robust screen, and we're usually doing it right around now after Q3 earnings, and we get our MACD best 6 months buy signal where we look at stocks. We go through the whole Zacks database looking for stocks that are kicking off an acceleration of revenue growth and earnings growth with good valuations, not running away from the market, not lagging the market, underfollowed by Wall Street, not a lot of analysts on it. And these are the kinds of companies that really, just produce those outsized returns. We put stops in, we trim the losers, we let the winners ride, we sell half on a double as a rule. We've done that twice with Super Micro since we recommended it in November of 22 at 81.93. I think it's split adjusted now. It's 8.19. So there's a couple of plays in our large cap portfolio. Right now, everything's just on hold. We're going to be putting on a new basket shortly. Some of the, powering of the data center and building the data center companies, MCore. We just sold half on a double there. That's EME. Just a little example. But you got to do your homework. Stick to your strategy. Yeah, you make some adjustments over the time, but just because the market didn't have this picture perfect seasonal sell off like it had in 22 and 23 doesn't mean that that's not going to work over the long haul. I mean, you can go to the website and click on our strategy, stocktradersalmanac.com, and see the long term results versus buy and hold and versus the worst months, and it just works. And you have to understand and believe, or at least accept the fact that the market is run by institutional big money, and they operate on a quarterly basis. And our, human society here revolves around these cultural behaviors where things happen around the third quarter, and the fourth and first quarters tend to be much stronger. People are adjusting portfolios. Managers are adjusting portfolios and putting money into the market at the same time each year. I've spoken about the October 31st deadline. So our long-term strategy, what I do in my IRA, is everything that is in the newsletter. I'm doing about a third of the portfolio in the best month switching strategy, where I'm buying the diamond, spiders, and cubes and Russells around October when we get our buy signal, and getting out of those positions in April, May, June when we get our sell signals. And we have a whole sector rotation strategy where right now most of the stock sectors are coming into a seasonally bullish period. Some of them begin and end slightly different times, and we've got correlated ETF positions with buy limits on there and targets. And then the other third of the portfolio is going to be geared towards the stock picks, which will be coming out the next week or so. Once we get through, all the quarterly numbers and all the third quarter earnings are in, and we can run the screens and dig into the charts and find some stocks that are sleeping under Wall Street's radar, but just making money and doing well. So that's the overall strategy, and it's working. That's why we've been putting this publication out for as long as I've been alive.
Dude, love to hear it, Jeff. And if anybody has any comments or questions when anybody else is talking, feel free to chime in. I'll go over to Cam. Cam, go ahead, man.
Hey, I kind of missed the original question. Is this just talking about our long-term investing philosophy?
Yes, sir.
Okay, great. So yeah, our philosophy is definitely based on asset allocation as the dominating factor. So thinking about what your goals are, and kind of aligning your investments with your goals. So thinking about, hey, do we want to be allocated to stocks or to bonds? And obviously, a lot of the audience here is going to be younger, and they're probably invested fully in stocks, and maybe they're stock picking. I help people with higher net worth and that are a little bit closer to retirement. So we're thinking about, a little bit more complex situations where we might need to have fixed income in the mix. We might need to have private equity, private credit, obviously real estate, and just thinking about the whole picture in terms of asset allocation, and stocks are just one portion of that. And then, of course, there's sub-asset classes even below that. We're talking about, are we, leaning a little bit more towards U.S. equities, foreign equities? That's where we kind of go in and do a little bit of kind of trimming around the hedges, or whatever you want to call it. We put our bias in a little bit there, but overall we believe in the passive index funds for the long term. Obviously investing where your conviction is and where data and history is strong. And then, of course, what I think the biggest alpha is in the market is tax alpha, right? Optimizing for taxes, whether that's tax loss harvesting, tax gain harvesting, Roth conversions, all that stuff. That's what I tend to post about on X, and that's where I think there's a lot of opportunity for people. If you learn about taxes, when it comes to long-term investing, there's a lot of tax incentives and tax strategies that'll help you outperform if you just buy the market simply and then do these tax strategies. It'll help you a lot.
I'd love to hear it, Cam. And for a little bit of background, guys, Gav is at the airport, and I'm one of his team members, so I'll be hosting the spaces tonight. Cam, I did have a question for you. How are you kind of navigating the election? I know it's going to be pretty impactful over the next 4 years. So are you changing your long-term investing strategy because of the election, and how are you going to navigate that?
No, personally, I'm not changing my long-term investing strategy. These cycles, obviously, there's a sense of uncertainty in the market, and I think that's the biggest thing, right? The market doesn't like uncertainty. So once we get closer to certainty, and sometimes the market even jumps the gun and goes a little bit early, but usually post election or whenever we get certainty from any big headline or any big unknown, that's when the market's going to usually rally after that. Or, of course, they could jump the gun and go a little bit before too. But no, not changing my investment strategy, and definitely just always tailoring my investment strategy towards my goals, towards my convictions, and things like that.
Awesome, man. We'll go. I see A has his hand up, and then we'll go over to Brett. A, go ahead, man.
It's good, my dude. Yeah, talking about uncertainty, I just chimed in when you said that if anything, uncertainty for a trader brings a lot of volatility. So if you can catch that uncertainty that you're talking about with the volatility, probably be a good trade. I think uncertainty brings a lot of opportunity in the markets, and I think Q4 right now is a lot of uncertainty with election year and if stocks are hitting all-time highs and done, if they're going to go higher. So in my opinion, I think uncertainty, volatility is is a good thing. What do you guys think about that?
Brett or Cam or Jeff, you guys want to chime in on that?
Sure. Uncertainty, 100% what the market dislikes. Kind of makes me wonder if there's any uncertainty going on right now with the market doing what it's doing.
Well, what uncertain? Like, are you uncertain about the SPY hitting the all-time high, or are you uncertain if crypto is going to go lower or higher? Like, what is the uncertainty right now? That is the biggest concern.
There doesn't seem to be much, is what I'm trying to say.
Yeah, agreed.
Even though you'd think there would be with this contested election coming up here. You asked the question about, are we changing our investment strategy based upon the election? Definitely not. It's not necessarily about who's in the office. It's about the event getting past us and moving on. It's about the cycle of how government tries to manipulate the economy to stay in power, and not the policies of the individual administration. There'll be some impacts here or there, but nothing overarching from my view.
I'll change my investment strategy based on who wins or not. For my opinion, I think if Trump wins, they're going to nuke it going into Q1. And I think if Camilla wins, it's going to be a early bull market ending. I think the bull market will continue a lot farther in 2025 if Camilla wins, due to needing the strong year. And I think if Trump wins, it's going to be like I'm not unvocal about who I'm voting for. Like, I'll vote for Trump, but I think if he wins, it's probably not going to be as great in the markets as people think. What are you guys' opinions on that?
That is actually pretty accurate. Republican administrations tend to have a worse post-election year than Democrats.
Absolutely.
And I think we'll see less uncertainty and a continuation of existing policies, so there'll be less adjustments need to be made by Wall Street. So
M2 is definitely not going to. M2 is definitely not going to continue on the trajectory that it's at right now if Trump wins, and that's a fact.
You said M2 as in the
yes.
cash?
Yeah,
I
absolutely.
think whoever wins, it's not going to go on the same level.
I think there's more of a potential for it to go and continue the trajectory if Camilla wins, just because, at least if she has a strong first year, then there's the potential for another re-election for the Democrats, where if Trump, it really just is a dumpster. Like I said, I'm very vocal, like I'm voting for Trump, and I think there's more potential for the Democrats. So I personally don't care who wins.
Just to talk about the spending of the money, which I think is important, it's really more about who controls Congress. We know that they do control the purse strings, and there's looking like whoever wins the presidency Congress is still either going to be split or may even go Republican. That's some of the handicapping. The best combination, which we have the chart in the upcoming 25 Almanac for the stock market, has been a Republican Congress with a Democratic president, where you have a conservative body, fiscally conservative, holding the purse strings, and a more progressive administration trying to drive new things through the legislation. So probably more related to who's controlling Congress with how much money gets spent.
Well, so think about this real quick. So this perplexes me all the time. So if the Democrats win, we already know that they want to appoint more Supreme Court members, and if they do that, it kind of divides the parliament more. Or opposite. Sorry about that. If we know that. Hold on one second.
If the Democrats win Congress, both houses, or if they win the White House.
Congress.
Right.
The White House.
It's still pretty hard to pass those kinds of laws to expand the judiciary. It's going to need quite a majority.
It's definitely possible, though, with Democrats. Would you not agree?
I'm not so convinced that they're going to be able to put that through. Oh, anything's possible, but I don't sense that's a real hard order to fill, to change the
So think
makeup
about
of the
this.
Supreme Court.
So I've been so perplexed about so many things because I'm constantly analyzing like more than technicals and fundamentals, like when it comes to like my investment strategy. So the more people that we bring into this country, the Democrat wise, like with the immigrants, would that not make more? What is the Congress? What is the electoral votes? Does that not increase the electoral votes?
If they redraw them, it can.
State?
Yeah,
Correct.
I think
And especially if we have.
That's an uphill climb, and I think that's a bit of sensationalism there. But you're starting to get into hearsay and stuff.
Yeah, no.
Right now, it's really hard to change those laws. I think on the local level, you can manipulate the gerrymandering much easier. But on a national level, it's going to be more difficult.
Yeah, but imagine. Oh, sorry.
No, you're good. I'm going to reel the conversation back in here a little bit. I'm going to go over to Gob, and then I want to go over to Brett first. But I'd love to hear it, guys. Gob, go ahead.
Yeah, no, I definitely wanted to go ahead and actually get Brett in here, and also maybe circle back around to Jaguar on, everybody tonight talked about how the election coming up is the only thing that they're watching, and hear Jaguar's perspective on that too. But Brett, would love to hear your thoughts on the long-term investing first.
Sure. Yeah. I personally, I'm not someone who would alter my portfolio ahead of the election. And I think the market's kind of saying the same thing. It just continues to chug higher. It's chugged higher all year, basically. Kind of ignoring it's the hottest topic at every dinner table, but it's not one that seems to be concerning the market whatsoever. And when you look at the long term, that tends to be the case. Generally speaking, the market tends to be a very good compounder over the long term. And I just, whenever I start to waver, I just think I go back to the stats. And for something like the S&P since the 40s. The index has risen 75 to 80% of the time on an annual basis. Basically, any way you cut the data, it tends to win, and it tends to win big over the long term. And when I think of my long term investments, I do like to make individual investments and invest in individual companies. But I've really learned to grow comfortable having a core position, either whether that's in the Qs or something like the S&P funds. It just helps bring a little bit of stabilization, I think, to someone's portfolio. I mean, and your worst, if you have a great year, stock pickers mark, everything performs really well. This year is a good example of that. S&P is up 23% on the year. If you outperformed it with your individual names, congrats. It's just icing on the cake, I think. And in the bad years, when individual names do bad, or maybe you got ahead of that, you're in cash waiting for some deals. The S&P will usually, outperform a lot of individual names. And so I think for a lot of investors, a lot of people are either fully in the passive camp, like passive index investing, or they're in the fully individual stock picks or ETF picks, or however, whatever their edge is. I think it kind of pays to have a little bit of both. When it comes to individual names, I'm someone who personally likes to blend fundamentals and technicals. Of course, the environment has to be right for that. Like when we have, the COVID pullback or the 22 bear market, some of those things, I don't want to say go out the window, but the environments are a lot different. They're not ideal. They're volatile. They're difficult. But with volatility, with uncertainty, that comes opportunity. I mean, it did not take a rocket scientist to, see something like NVIDIA shed 2/3 of its value and scoop some of that up. I mean, half the Magnificent Seven was absolutely crushed. It didn't, you didn't have to be a genius to step into those names and think that they could outperform 4 or 5 years down the road. Of course, it didn't take 4 or 5 years. Most of these names have done pretty damn well since then. But I think, for me, I like to have a good core, and then sort of let that buoy my portfolio. And then I look for opportunities, and I do skew more heavily towards tech, but I do like opportunities outside of that too. And I do tend to look for the long term and try to find companies with good brands and strong margins. Obviously, it helps when they have positive earnings growth and revenue growth forecasts. That's not always the case, depending on your timing. If you're looking at 1 to 2 years, probably going to want that. If you're looking 1 to 2 decades, most likely you're going to have to buy when, there's no company is going to grow earnings and revenue every year for 20 years, most likely. So sometimes you got to be willing to, use a little bit more art than science. But that's kind of how I like to do it.
Awesome. We'll go back over to Gav.
Yeah, love it, guys. Great points. Hey, Eric, I believe I see you popped in a little early here. So I'd love to get your thoughts here on this long-term investing conversation. Specifically, we were discussing the upcoming election. Everybody keeps talking about how, hey, we love, how the market looks. We're so bullish on the market, but this long-term election is, this election affects how we go about this long-term. Maybe that's Rob up here. Maybe you have Eric coming up here right now, but Rob, maybe you can speak to that first.
Yeah, I think Eric's on. I did want to just touch on something Brett said there. When it comes to individual stock picking, which we are not, how many folks you got on here? 300, 400. It's highly improbable that the next Warren Buffett is in here picking individual names with consistency, right? I mean, I'm sure there's some really great traders. But when it comes to, and there's one thing that he really said that sticks out in my mind is that engagement aspect of that, right? And if anybody else is a tasty trader in here listening to their kind of methodology, Tom Sosnoff talks about engagement all the time. You might be a not incredible stock picker, but if those little, 1, 2, 3 small positions in your larger portfolio keeps you engaged in the overall market, that's only going to be a good thing. So you have more broad, awareness of what's going on in the market. But certainly taking 100% in your portfolio and trying to pick, individual names, we don't find that there's probably a whole lot of success in that.
Well,
there's so many. Sorry, Sam. There's so many ways to go about the long-term investing. I completely agree. And Eric, I see we got you up here a little bit early as well. Maybe you can weigh in. We've heard so many different approaches to long-term investing. We've also been talking about how this election is going to affect it.
Yeah, I'll chime in, and I just got the last few minutes, but regarding individual stock picking, I don't do a lot of that, and here's the reason why. And this will be an easy one for you guys to remember. And most of you have heard that most active managers don't beat the market. But what if 10 years ago, what if I said, hey, you could have Warren Buffett on retainer, personally managing your portfolio, no charge for the next 10 years. You have free advisor, Warren Buffett. Would you give him some money? Most people said, absolutely. And I was just looking at some investments, including Berkshire Hathaway, because I own Berkshire Hathaway. And it almost exactly matched the S&P matched the return of the S&P 500. It was within about 1% over the last 10 years. So it basically tied it. So even the best and brightest large cap U.S. stocks, that's a very efficient market. In other words, what you guys know is not much different than what everybody. Information comes out so quick because of technology that it's very hard to get an edge in that, in my opinion, and the evidence shows that. it's very hard to get an edge in that particular style. Now, if you go into small caps and private stuff and real estate and other things like that, it's easier. The research makes more sense. But large cap US, I don't waste, in my opinion, I don't try to add value by picking stocks. So I think there's a lot more value to be added by allocating assets. And what I mean by that is, a 1-star large cap growth fund is going to do better than a 5-star bond fund over the last 12 months. And so my point there is you have to allocate in the right categories. My personal portfolio, I own probably 8 or 9 names that I've owned for over 10 years. Microsoft, John Deere, Apple, Blackstone, Accenture, BlackRock. What else do I own? I own another, Google, Alphabet. And it's really a tax thing there. If I sell those now, I get slammed with taxes. So, but my new money mostly goes into ETFs. So that's, I think people should spend more time thinking about things like, how do I reduce my taxes, and am I saving enough, and what type of an account am I using to make sure this doesn't get killed with taxes, things like that.
You touched on it a little bit there, Eric, but what are your thoughts on ETFs compared or versus stocks in the long-term investing approach?
Well, when I started, in advising clients over 20 years ago, the very first ETFs were index funds that just like SPY. I think that's the oldest one. It would track an index. And whether you own an ETF that tracks SPY or a Vanguard mutual fund that tracks SPY, they're virtually the same thing. One you see moving throughout the day, one prices at 4 o'clock. Other than that, they're essentially the same thing. So I would compare both of those, which are either index portfolios or managed portfolios, baskets of stocks. A mutual fund's a basket of stocks or bonds or other assets. An ETF is a basket of securities. Those automatically are going to be more diversified and more predictable than single stocks. I mean, that's I think everybody knows that. So I just think that if you want to have the most predictive outcome and capture the 9 or 10% averages we have over the last 100 years, it's too risky to try to dart in and out of individual names. When even, you have groups of, and I've never seen a mutual fund or an ETF with any sort of track record that has made its money through market timing and darting in and out. The ones that beat the market do it by just a little bit. And they do it by, picking companies that they think are undervalued, and they have a whole period of years.
So what do you think about Bitcoin's ETF on the ETF topic?
I own that personally. I think that having a small portion of a typical portfolio allocated to whether it's real estate or whether it's gold or whether it's Bitcoin, all of the above, I think makes some sense. And the Bitcoin ETF is the simplest way to do it. I just think it's so easy to just buy it in a brokerage account and have it, alongside your other assets. You have it in an IRA. I know there's an argument, and Rob, maybe you can chime in on this, to own it, in a wallet, and you don't have the intermediary risk. But a company like BlackRock, the money they're making off their Bitcoin ETF, it doesn't even move the needle. It's such a small rounding error. And what I'm getting at is they're not going to take everybody's money like a company like BlackRock.
What are your thoughts on ETH ETF? Do you think it's going to see the same potential as Bitcoin? I think we're in the process right now of seeing a ETH run up ETF. I think it gets one run up at least.
I don't know about that. What I will say is I think that the regulators just passed the ability to trade options on the Bitcoin ETF, and I think that's
stupid,
really cool, because I think a lot of people, including myself, kind of want to own a little bit more Bitcoin. They need to, but then it's scary because you have guys like Jamie Dimon and Warren Buffett that say it could go to zero and that there's no earnings. There's no, I always like to buy companies over currencies. I like earnings. I like dividends. I like products. And then you don't have that with Bitcoin. So in the back of my mind, it's always, okay, there's a small chance that it could just evaporate. I'm not going to get that by buying. It's not going to evaporate if I buy real companies. So with these options, I look at it, not buying call options on it, but hedging by, creating buffers and straddles and things where you can get maybe 60, 80% of the upside, but you have maybe a max loss. And I think you'll probably see some products around that. So that people can invest in an aggressive asset class, but they'll know maybe their worst case loss or something close to their worst case loss.
Adding the optionality to the products is always going to be a good thing, especially when you're talking liquidity, right? Increased activity around those products. We don't want to, this isn't a Bitcoin space, we could go pretty deep into that. But to the question specifically around optionality, anything that increases liquidity, we're for.
Totally levels the playing field.
Before I send it over to, go ahead, Gav.
Yeah, I'll jump back in. Eric, I know we're going to roll into this asset allocation conversation together with Wheel as well in a few minutes. The other gentlemen that you invited, are they
he said
ready to go in a couple minutes here?
Patrick says he's on, but he doesn't see himself as a speaker. Does he have to get?
So he has to hit the request to speak button that's in the bottom left.
Hey, Gav, what are your thoughts on
ETFs?
I'm so curious.
I think I lean similar to Eric. I don't know if we're going to see the same types of inflows as we saw into Bitcoin, but there's possibility. But let me rotate topic a little bit here because I want to make sure we get up this other gentleman, and then real quick, Jaguar. I wanted to throw one more question at you before we go into these other areas, and that was just your thoughts here on utilizing ETFs and what your thoughts are around like the best ways that retail can utilize ETFs long term in their portfolios.
I can only speak for myself. There are certain areas in the market where it's very, very hard to differentiate between different types of equities within the same asset class or same group of stocks. And for example, I'm talking about the energy sector, right? Where the entire cabal moves together, generally speaking. And so you're not really getting any significant alpha. For example, when you're buying ExxonMobil or when you're buying just XLE, right? And so, or if you want to go similarly, if you want to go buy, if you're buying within the oil services sector, and if you're buying somebody big like Schlumberger versus just buying OIH, sure, in the small and the mid cap space, you can start to see some differentiation. But generally speaking, the entire energy complex move up or down, right, simultaneously. And so the easiest way to trade is basically just go with the sector ETF, whichever direction you might be going. And to a certain extent, you can apply the same logic to regional banks, right, KRE, and a couple other areas in the market. So when I'm bullish on a particular group for whatever the background might be at that particular time in the state of the markets or the state of economic conditions, I simply go with the ETFs. And frankly, that's probably the only time when I use ETF, because as an active trader, I'm pretty active in picking individual names and then doing my work in those stocks. So the only time I touch ETFs is when I have this bigger view on the entire group simultaneously, which makes it much, much easier to just trade that ETF rather than picking individual names.
Right. Yeah. So I hear that makes sense for you. I think a lot of the people and some of them are on this panel too, do take some of that longer term approach as well. And so I think, we're hitting 6:45 p.m. Eastern here. We're going to roll into this conversation here around asset allocation. And Eric, I'd love for you to kick us off. I posted a graphic, and I put it in the top of the space showing SP 500 trailing PE last 12 months versus SP 500 annual return next 10 years. And I'd love for you to explain what really stands out to you about here, and then maybe also just some high-level introductions around who you are and what you do as we get into this.
Yeah, I'll do that. Do you see Patrick yet? Is he?
I don't. He just has to request to speak. Once he taps that request button, he'll show up right here at the top of our screens, and we can bring him up.
Yeah, that chart is up and available for people to see.
Yes, they can. They can. It's up in the nest.
Yeah. So I think this is, when we talk about valuing a business, whether that's the corner dry cleaner, Walmart stock, or a CPA practice, private, public, whatever, it's generally the price to earnings ratio, a multiple of earnings, is the most common measure. And if someone's looking to buy that corner dry cleaner, that small mom and pop business, they're going to look at how much it makes net of all the salaries and expenses, and they're going to pay a multiple of that. And larger companies are valued at the same way. Now there's more that goes into it, but that's kind of the cornerstone, and that's called the price earnings ratio. So if you have a company, the corner dry cleaner makes $300,000 a year after everybody's paid, someone might come in and say, okay, I'll give you $1.5 million to take over that stream of cash flow, and they've just paid 5 times earnings. Okay, so that dry cleaner was trading at a PE of 5 multiple. And if the dry cleaner was growing really fast, it was in a hot area, maybe it had some new method to clean clothes better or cheaper, or some fancy app or whatever, and it was growing its earnings faster, maybe it could trade at 8 or 9 times earnings, right? So growth matters, but as a long-term asset allocator, okay, Rob and I and Patrick that'll get on, we are not traders. We're long-term asset allocators, meaning we will, and I'm going to use this example, I always do, but my 9-year-old plays baseball. And when the coach places the players around the outfield, he is not guessing where the ball's going to go. There could be 3 straight hits between second base, shortstop, all right in there. And he's not going to say, well, you know what? There's a trend there. I'm going to get the right fielder over there. I'm going to get the center fielder over there. Because that's obviously where the ball's going. Any idiot can know that. He doesn't do that because he knows that Murphy's Law says as soon as he does it, there's going to be one that's hit to right field. So very much like the manager of a baseball team, when I set up my private client accounts, we are allocating assets. Okay. So we're going to place some in, large US companies, whether we use, an S&P index fund, an actively managed fund, a diversified group of 20 individual stocks, that's fine tuning. The big picture is we got some percentage allocated to large company US. Then we're going to have some small companies. Then we're going to have some international. Then we're going to have some real estate. Maybe there's some alternative investments in there like private equity. But the category that most people consider quote unquote the market is the S&P 500. That's large company US, one of those asset classes. It's the one that's the most talked about, but when I allocate money, they're all important, but the S&P is the one that's most talked about. So let's look at the valuation of the S&P. And that's what this chart shows. The historical average over the last 50, 60 years, the S&P historically averages trading at about 16 to 17 times earnings. So on average, people are trading about 16 to 17, paying about 16 years worth of earnings for a share of stock. Right now, it's trading at a forward multiple. And let me explain this too. When I say price earnings, are the earnings the last 12 months or are they the projected next 12 months, right? There's a difference. So it's trading at a forward multiple at about 24 times earnings. And it's trading at a backward multiple of nearly 29 times earnings. So earnings revisions have gone up. Therefore, the forward multiple is a little bit lower, but 24 historically is still very high compared to a 16, 17 times average. Now, some of that's because of the Mag 7. Those are all trading at elevated PEs, and they're skewing it a little bit. But nonetheless, it's by many experts, we are in a fairly rich valuation mode. Well, let's look at history. What this scattergram shows is the next 10-year average return. So the average annual returns for the next 10 years based upon an initial price earnings ratio of a certain amount. So let me give you an example. So on the left, we have the average annual return of the S&P over the next 10 years. And on the horizontal axis, we have the trailing PE. So as you can see, when PE ratios get higher, the next 10 years are pretty miserable. And this chart, I mean, there's an obvious sort of trend there. It just kind of slopes down and to the left. And what that's basically saying is when you start at an elevated PE, your next 10 years are not that great because you kind of get back to this reversion of the mean, back to a more reasonably valued market. In fact, when the PE ratio gets over 25, those are when we have those lost decades, those 10 years where the market does negative or just barely breaking even. So what I do with my personal money and my clients' money is now we do the opposite. When you start at a low price earnings ratio, and this is typically after, a bear market, early 2009, when things got kind of overly sold off, PE ratios were very good. The next 10 years, very good average annual return. So I think right now, after 2 really good years, 20 plus in the S&P, we kind of have to step back and say, let's look at the next 10 years. Where are we at? And by the way, the PE ratio is a horrible predictor of the next 12 months, but it's a remarkably good predictor of the next 10 years. So again, if you're a trader, this isn't the chart for you. But if you're just like 401k investor, IRA, you don't want to look at your account every day, just buying the S&P, you might want to temper the expectations down based on where we are now. We've kind of pulled forward some returns over the last couple of years. So we'll get to it after Patrick talks. But what Rob and I think a lot of investors, professionals included, are under allocated to yield-based strategies that produce income regardless of if markets are rising.
Yeah, I love that rundown, and I was able to get Patrick up on stage. Patrick,
good. How are you? Can you hear me all right?
We got you.
Yes, sir. Loud and clear.
Perfect.
Would you mind giving a brief introduction for the audience?
Sure. Patrick Malden here. I have been in this industry for 25 years coming up. I have been a financial advisor. I've also navigated a long-term commitment to helping institutional investors. So I work a lot with registered investment advisors, endowments, family offices, banks, trust companies, and so forth. And so we to be frank, we go a little deeper than the conversation will allow today. But the premise is to really help institutional investors figure out parts of their asset allocation and long-term investment commitments. And so that's what I've been focused on for the last, call it 20 years.
Beautiful. So can you speak a little bit to what Eric was talking about there, this long-term approach in the areas of allocating towards ETFs and yield-focused products? And just a note, Eric, when you're not speaking, if you don't mute, we reverb through your mic back into the space, just when you're not speaking. But Patrick, I'd love to hear your deeper thoughts on what Eric was speaking to there.
Yeah, let me take a step here real quick, because we're talking about investing for the long term. I overheard some conversations about individual stock picking and actively trading. This conversation's probably not going to address those type of investors. This is more sort of how do you figure out some of the nomenclature or lingo that this industry throws along at you. And with that, let's just deconstruct some of the concepts here. Long-term investing, right, and asset allocation. So let's start with the first. What does long-term mean? And it means different things to different people, but at the end of the day, if it's at 5, 10, 15, 20 years, it's always going to be different for everybody. But we've sort of settled industry-wise on 10 plus years, which we define as long-term. Okay. So asset allocation, that is really a diversification process. And I'll just say it this way, for my active trader friends out there, when you diversify, I always say you have to apologize for something by design, right? Because what you're doing is you're trying to not have all your eggs in one basket, one stock, one ETF, one mutual fund, so forth and so on. So you really try to diversify your allocation. And so most people go, okay, so if I'm not sitting down with a financial advisor, how do I think about this? Well, there's you can Google all this stuff out there. The common rule of thumb is to take your age, right, and subtract it from 100. So as an example, and that percentage will then be dedicated towards equities or stocks, right? So if you're 40 years old, you subtract that leaves you with 60. So at minimum, you should probably look at a 60% allocation towards stocks, and the rest, we'll just say bonds for argument's sake. So 60-40, or in this case, 60-40. That's come under a lot of scrutiny, quite frankly. That rule's been around for a long time. And one, it's very simplistic, so it's a starting point. Secondly, it is said that we are living longer. So if you're budgeting for retirement, what have you, if you're looking at this, you probably have to bake in a few more years so you don't run out of money. Simple. So the industry, those folks who subscribe to this rule of thumb, if you will, have bumped that 100 up to 110 or 120. So in that example, 120. So now you're not at 60% equities, but at 80. So you can see right there's a lot of wiggle room is trying to figure out an asset allocation, or at least the percentages of how you are to accomplish this. But again, that's sort of the reality is everyone should consider this, and advisors I work with and clients we work with, we just say, look, everyone's different, and let's establish sort of a risk reward profile for you. And in other words, as Eric was saying, the PE ratio is a great indicator for long term, not such a great predictor for short term. We've got a lot of uncertainty as you can, if you look around the world. People are getting a little nervous, not just with elevated PEs, but also with what's going around the world. And then we've got this little thing called an election coming up. So we have to sort of be cognizant of this. So folks, ultimately, what is your risk appetite? How do you go about that? I always say, look, folks, it's your money, not anybody else's. What you do with it, it's your business. If you're looking for guidance, that's obviously a good idea, I think, for many to help sort of shepherd you along in your journey. So once you define your tolerance for risk, you establish, through a risk profile, what have you, then you start beginning the fun stuff, which is, okay, now we got to fill the buckets. Let's just keep the analogy simple. We came up with a 70-30, 70 stocks, 30 bonds or fixed income. Now we have to dive into the equity side. So is it growth? Is it value? Lots of folks are looking at value at this point because they're saying, well, you know what? Their multiples aren't quite so high. Exxon came up a minute ago. You just look comparatively in the industry. If you're buying individual stocks, how does that relate to other companies? How are they positioned for the next market cycle, if you will? And so there's some great companies out there outside of, what we would refer to as the Mag 7 that have been, sort of stealing the show here lately. But then you drill down further: large cap, mid cap, small cap. Do you do domestics, international? You bifurcate that between emerging markets and developed markets. So there are all these moving parts, right? And of course, each carries its own risk reward profile. On the fixed income side, let's say we're going back to our example of 30%. Well, you've got government securities, T-bills, treasuries, so forth and so on. You've got municipals. You've got corporates. You can split up corporates between investment grade and high yield. And then there's other ones out there where you could sort of think about, okay, how do I navigate through this? How do I get the best yield? And ultimately, how do I do that in the most, safe way possible? Now, the problem with bonds, we prior to 3 or 4 years ago, we did enjoy a pretty long-term bull market in bonds. Anybody who's been invested in bond funds, especially sort of the run-of-the-mill aggregate bond funds, has probably been disappointed here over the last couple of years, because it's just been so difficult with rising interest rates. And now the thinking is, okay, interest rates are coming down. We saw a 50 basis point cut. If you look at SOFR, if you look at the dot plots and so forth, you can see that the market is starting to price in anywhere, from 5 to 6 cuts. It was 8 to 9 cuts before they did the 50 basis points. So that's not a constant. It's always changing. So you sort of have to pay attention to what's going on, especially in fixed income, because as we learned, unfortunately, here recently, bonds are not the safe haven that they were, sort of projected to be. And now you have to really think about things like duration. You have to think about credit. You have to think about convexity. You have to think about yield. Okay, how much yield am I wanting to get? Let's say you want 5-7%. Where do I go? How much risk do I take? Interestingly enough, 6 months ago, there was a company here in Ohio. Most people know them. They're down in Cincinnati. And they offered a bond that was 17 basis points above Treasury at a 5-year duration. That's difficult to swallow, right? Because you're assuming that you're lending a company money, but if the government, which is government guarantee, gives you virtually the same thing, why would you necessarily go down that road? Key is diversification. You have to think about these things, right? So, and then as I started thinking about this, we have left out a significant portion, which is cash. A lot of advisors will tell you, hey, 6, 9, 12 months, depending on the situation, you should have cash reserves in case for a rainy day. And then ultimately, we forgot the whole asset class of alternatives. That includes but not limited to commodities, real estate, and business development companies, so forth and so on. So there's an array of alternatives that you could use in order to give yourself an additional diversification element and potentially, safeguard your portfolios from a significant decline. I'll revert back to something was said earlier on I think Eric mentioned that 401ks, right? So most of us have a defined contribution plan through our employer. That may be a 401k, a 403b, simple SEP, what have you. And those are your, you plow money in for your retirement. Some max it out. We encourage as much as you can, put it away. A lot of times you'll see these target date funds in there. These are interesting simply because they provide an avenue for somebody who may not be is dialed into these things and say, okay, well, I'm not interested in learning. I don't want to necessarily, actually look at this or have some work with somebody. I need something for the time being. These target date funds accomplish that goal. And again, I don't advocate for them, but they are a tool in the toolbox that folks can use if they are so inclined and they don't get any other additional help in order to diversify them. And also, as they're marching towards that goal, which is in this case retirement, every year the asset allocation will skew to a quote unquote less risky scenario. Again, that typically means you're taking away from equities and you're putting it away into bonds. So again, it hasn't worked out all that great over the last 3 years. So we can go on and on and on. I'm not going to. I will say to you that bonds are of interest to me just because it's so difficult to really figure out what should I do? Should I go longer term because interest rates are going down? Do I lock that in? Is that already priced in? For the most part, it is. How do I think about these things? Should I stay short on the curve? Should I go longer? Should I go in the belly of the curve? Again, this is for folks who are a little bit more astute in this process as far as trying to figure that out. I sort of look at this from a risk analysis standpoint again, and this is why I have to speak very general because we're not talking about your particular account. But post GFC, Great Financial Crisis, we've seen an elevated correlation in stocks right afterwards. Quite frankly, everything was sort of pegged at the same rate. It was just, it's just all the same. And that obviously that has changed, and we can just see that by the recent enthusiasm for the tech stocks. So again, to recap, time horizon, make sure you understand it, understand the tax consequences, the financial demographics, such as your income needs. This is where planning comes in nicely. Your emotional risk capacity. That's really an interesting one because, again, everyone is different. Some folks have a lot more appetite for risk. Some folks do not. Figure out who you are, because in the case of a 20, 30, 50% decline in your account value, how will you feel, right? Markets go up, yes, but they also go down. And how do you insulate yourself? Win by not losing. There's an old saying there: if you lose 50% of your value of your investment, you need what to get back to even? And that number is 100%, right? So be cognizant that downdrafts or market declines can have a significant impact on your goals to achieve them. So arrow on the quiver, we certainly have tools, and I think this is where I'll segue over to Eric and let him dive more into what he's doing and how he's accomplishing those objectives. So thank you.
Yeah, thanks, Patrick. I want to just talk a little bit more about true asset allocation. Asset allocation is different than diversification. Okay, diversification is maybe just owning, 8 large cap names in some different industries, but they're pretty much still all going to move together with the market. If you own Eli Lilly, Costco, and the Mag 7, you're not fully allocated and you're barely diversified. When I got into doing what I do, it was in late 1999. It was right during this last tech bubble that had been coming because of .coms and so forth. And tech stocks had 3 negative years in a row, but small cap value, real estate investment trusts, emerging markets, that got my clients through that time. Those produced positive rates of return over the 3 years because they're not the same thing. They're very different. And so I know some of these asset classes like that I just mentioned don't look as good over the last, say, 3 years as the S&P or certainly tech. But trust me, you're going to need them. Sometimes you're going to be glad you have them. True asset allocation is getting things that are not all perfectly correlated to one another. Not just different industries, but different capitalizations, totally different categories, emerging markets, real estate, maybe some hard assets, whether that's gold or a little bit of Bitcoin, things that don't always move together. So, and then what we really do, what Rob and I do is we've done this for clients for years, but we finally rolled it out as a publicly traded ETF. We take not the S&P, we divvy it up into some sector ETFs, but it's basically broad market exposure. But we write put options and call options against underlying assets to create income. The downside of it is that it caps our gains. So our product profile is we're probably not going to make too much more than maybe 20% in a given year. We could, but that's more or less our kind of unwritten cap. But we're going to get double-digit yields, 10, 15%, maybe more in current yield. We're trading current income for, big capital appreciation gains. And And so we can still make that income even in a flat market, even in a range-bound market. We do what's called an option wheel strategy. We start with a cash secured put, and we write it out of the money. And options can get complicated. And I'm going to assume some people know the basics, because otherwise this is going to take a really long time. But selling options as opposed to buying options are the conservative way to create income. We don't do the other side of the trade. The other side of the trade is speculative. You can buy a call option and really leverage yourself, and if things go up, you do great, but then you lose all your premium if they don't. Or you could buy a put option. You really do well when things go down, but then if they don't, you lose your premium. We're selling it to the speculators. So we're kind of like the casino. We're kind of like the house. And we don't get the massive gains, but we get nice income and we reduce portfolio risk. And so we write an out-of-the-money put, fairly short-term in nature, maybe a week. And we get a cushion on the drop. So it can drop a little bit. We won't lose anything, and we collect a premium. If it does drop to our assignment price, we get to buy it lower, which we like. And then we hold it and we write a call on it. So it becomes what's called a covered call. And so we get income from the put. And since a cash secured put, as opposed to a naked put, we're getting income on our cash. And then if it does get assigned, we own it. Then we write a call and we get income from the call. So it's triple income. And then, when it rebounds, it'll get called away. And then we start over again. So if you go to our website, peerlessetfs.com, it's called the Peerless Option Income Wheel. And that methodology, which is very much rules-based, is it's a method of harvesting premium around kind of just, we call them strike prices, but we don't need the market to go up to get decent returns. Now, nothing is without disadvantages, right? There's no silver bullet. So it's about trade-offs. We're not guessing where the market's going to go. We're not favoring certain sectors. We're providing a tool to create respectable returns, something maybe close to the long-term performance of the S&P, 10%, give or take, but doing it without requiring markets to go up. So we're not going to get the big months and the big years, where it's going to be more slow and steady, but more than like bonds and cash, with less volatility than the S&P. So that's what we call an option wheel. We're the only mutual fund or ETF to ever package this strategy into something that's available for everybody. If you were to run this on your own, not only would it take a ton of time, expertise, so forth, but it would take probably, to properly diversify, several $100,000 of capital, because if you're writing cash secured puts, one option contract's the minimum. If you're doing it on a, say, 300 per share ETF, that's 30 grand you got to have in cash. That's one position. You diversify, you're at a few $100,000 pretty fast. So it's we've been doing it for clients successfully. As far as allocation goes, I will put, let's say I had a client that had well over 10 years. They're okay with the downdrafts and not panicking and selling low. I would, without this wheel strategy, I might normally have a large cap growth fund, a large cap value fund, a small cap fund, an emerging market fund, and a real estate fund. Probably skip the bonds because they got over 10 years. But then I might have maybe 20% in something like the wheel, in case we get this lost decade over the next 10 years. I want something in the portfolio to make me some money, right? If the ball never gets hit to right field, you're like, why the hell do I have somebody over there? But when it does, you're happy you do. And that's kind of why we created this strategy.
Love the thoughts being shared here and just everything throughout. Sorry there, Sam. I wanted to bring in Austin as well, because I think, Austin, you can really resonate to this idea and concept of the long-term investing, but doing it through asset allocation. Then, of course, the wheel strategy, which I'm super excited to have you on, and we can discuss a little bit here as well. Austin, what's your thoughts here?
Can you hear me all right?
Yes, sir.
I mean, personally, I love it. and like I said, we use it in the Discord. We use it with a lot of the stuff we do because it allows you to almost have a risk managed downside protection with the opportunity to buy a good name at a discount. And I think that you really can't pass on that opportunity. Now, personally, what I love about what you guys are doing, Eric, is that it's done for you, number one. And number two is that, the reality here is that, yes, we could run the wheel on some small cap stuff, and yes, it can work. But to scale that strategy is near impossible without the right amount of capital. And that's one thing that I like is that you guys do create that ability because you have the capital to do it. And I guess really the experience is invaluable to do it at scale with that large of an amount. So I guess I do have a question, right? Like one thing that I've been asked, right, when we've talked about what you guys have going on is, what is the most premier market condition for you guys to be maximally successful if there is one, and how would you kind of define that? Because I think I would love to hear that, and I'm sure other people would too.
Great question. We're going to do, in a raging bull market, we're going to do well, but we're going to underperform, the S&P 500 and that type of thing. And I'll give you an example. Last year, so we've run this in a hedge fund for almost 3 years now, formally, informally before that. 2023, it was up about 22%. I think the S&P was up 25, maybe 26. This year, because the ETF only started trading in May, but the fund for calendar year to date is up maybe 16%. The S&P is up out of 22, something like that. So we're not gonna, in a raging bull market, you're gonna be happy, but not as happy as if you would just go long, right? However, every other market, you should be happier with this type of strategy. I'm gonna explain that. In a moderate bull, when we're writing these weekly premiums, we like them to annualize around 15%. That gives them a low probability of getting assigned, but a respectable return in a bull market. And then we might get another 4% on our cash. So that's where you get up to close to 20%. So a moderate bull, we should perform the same or better than the S&P. A flat or range bound market is really the best market on a relative basis. In other words, relative to the other choices that you'd have. This will be, this could very well be the best thing in your portfolio. Nothing else, seems to be working. In a down market, a slightly down market, we're going to be fine because we reset the strikes every week. We create a new buffer. In a real nasty bear market, we're going to be down, but likely we're not going to be down as much because there's a buffer. We write these puts out of the money, plus we're getting some call income. So in 2022, I think our hedge fund was down between 10 and 11% as opposed to down 20% for the S&P. And I want to, since Austin brought this up, I want to caution people, and this is not to kind of pump up putting money in wheel, just a word of caution. If you're running wheels on your own, the temptation, if you don't have a lot of capital, you're kind of forced to buy lower priced securities. And, $10 names, $15 names, because, minimum contract size is 1. So if it's a $15 name, you have to have 1,500 cash secured. And those types of names are more volatile and the premiums can look really rich. Oh, I'm annualizing this premium and, it's 63%, but these names are volatile. The premiums are high for a reason. What happens is
if you could also throw in some, because the spreads are often quite wide too. And I think that's something to highlight.
Yeah. The options are definitely less liquid. The reason we don't write options on individual stocks. We do them all on sector ETFs. And here's why. When you're running a traditionally long strategy, let's just say, you got 15 names that you follow, you like, they're good companies, and you're kind of buy and hold. And in any given year, you might have a stinker that's down 70%, but it's going to be offset by your best couple that might be up 70 or 80%, right? So it's okay. Well, when you're doing this, writing puts or cash secured calls or running the wheel, we know in advance we are capping the upside. In our case, maybe 20 to 25%. We are not going to have any massive winners that get beyond that. However, if you get assigned a name you can keep going down with it. So you can get that stinker down 70%, but it's not offset by the winner because they're all capped. So you have to be hypersensitive about the downside. What that means is you have to hyper diversify. You can do it with individual names. Just make sure you do it on at least 8 or 10 and that they're different. Not all tech stocks. Own an energy, own a bank, own a tech stock, own a healthcare name. So they're not all moving together. And we don't want the risk of getting stuck with, you know, a Walgreens stock that used to be 90 and now it's 20. Because that's just going to, you know, there's a lot of other examples. You know, that's going to just, Moderna is another example. And when we started this years ago, we started doing it with individual stocks. And, you know, you can do it that way, but got to be protective of the downside. And by using sector ETFs, they're always going to rebound. You're not going to get, you know, caught with one of these things that just screws your whole portfolio.
I was going to say, I was glad you brought that up because I was going to bring it up if you didn't, but I love it. It's just the reality that we need to have coverage wide scale, and going independent name does carry so much more risk because then you get the outperformer, especially like in healthcare, biotech, anything that would terrify me. You get some sort of weird catalyst on one name and you can be completely screwed.
Yep. That's why we're doing the ETFs, but we do it on one of our positions is IBB, which is the biotech ETF. We break out the sectors of the S&P because we get a lot more option premium from each sector than we do if we just did this on SPY. But we're still diversified because we're owning most all the sectors.
Right. And just to kind of distill that for anybody that's newer to investing or trading in general, what he's saying is that like if you get the outlier of one name outperforming, it's not going to draw the entire ETF up in a way that would put you in a risky position.
Yeah, and in fact, when we did used to do it on individual names, we would sit out during earnings week because we don't get the benefit of it skyrocketing by owning the shares long. All we're going to get is our option premium if we're writing puts. That's it. Right. So it doesn't help us if it skyrockets. Maybe we get a little more option premium because it's more volatile week, but we're opening ourselves up to the majority of the downside. So that to us was an asymmetrical return profile. So we would just usually sit out earnings weeks.
Awesome. Thank you for answering that in the detail, my friend.
Yeah, it's a lot of good points here, and I think it's going to be really helpful for the long-term investors. Shai, do you have any thoughts here?
Yeah, I mean, I think 99% of retail investors should choose the ETF route rather than specific stocks because the risk just outweighs the reward. If you pick the wrong, if you pick losers and don't get any of the winners, you miss on a massive rally the past year and a half. And the caveat is, if you've been parking your cash on the sidelines, getting that 5.5% risk-free, what now with the market being up? Like Q's been up 80-something% the past 2 years. Like you don't want to really get involved near a market top. So this is an interesting strategy to eliminate that if you're a long-term investor type of approach. But question for you is, what are some common mistakes that people do make when choosing ETFs for long-term investing? Because we have been experiencing a gold rush in ETFs in 2024. So like, what are specific call-outs that you want to mention that will help folks pick the right ETFs for their long-term perspective?
Yeah, I think the biggest thing is ETFs are getting extremely specific these days, and they're getting into highly niche strategies that can be dangerous. I mean, they can skyrocket too. And there are companies, I won't mention the name, you probably know, but there are companies that have single stock ETFs, which in my opinion is almost like an oxymoron, right? An ETF is an exchange traded fund. Fund means like, a bunch of companies. So when it's based on one stock, it's not even the purpose of it. So I think you just have to know what you own. You could have a total market S&P 500 ETF that's very plain vanilla. It would be great to hit that large cap core space. But then you can get super detailed. You can, if you want to place bets on the banking sector, I think there's a bunch of regional banks that are having earnings this week. You could buy the KRE, you could buy a call on the KRE. But if you're just kind of more of a longer term set it and forget it asset allocator, try not, be careful with the super specific ones. And there's a ton that are in our space too. Option income strategies. Ours is extremely diversified. We're not just writing calls on the tech sector. We're kind of really, really well allocated. We do it on REITs. We do it on energy, all the different areas. We're writing puts too. And then we also do calls. We paid a 60-cent dividend our first quarter. We should pay it. They don't let me tell you what we think the dividend will be, but we in all probability, it'll be higher than that the fourth quarter. But this is not going to be, we came out at $20 a share. 5 years from now, I would still expect this to be right around $20 a share. This is not something that's a capital appreciation play. It's an income play. And like the last person said, it's an in-between investment from cash versus just jumping all in long, because we have this kind of income and some hedging. When we got that, and the ETF's only been traded for like 5 months, but when we got that yen carry trade scare a month or two ago, the S&P, believe it or not, was actually down 10% from peak to trough. And wheel was down about 4.5%. So it's still, it's still gonna be affected by ups and downs, but in a much more muted sense because of the way we're doing it.
Gotcha. Okay, that makes a lot of sense. Another question I have for you is, I feel like the characteristics or perspective for long-term investors has changed over the past couple of years. Clearly, 2020 caused a rapid, the market went nuclear on the upside, and any kind of pullback we're getting is usually a V-shaped recovery since 2023. Have you noticed on your end of the business any characteristics changing on the long-term investing, or is this primarily in my own bubble on aka FinTwin and like the Gen Zers or young millennials, or that long-term investing is kind of altering a bit, but really the bulk of the 35-year-old plus is still status quo?
I think there's definitely been, I think people get more and more, their risk tolerance gets more aggressive toward the end of a bull market. Because if you think about somebody that's maybe only 35 years old, that's been investing for, 10 years max, maybe shorter, the majority of that time we've been in a bull market. And like you said, the pullbacks, COVID was weird. It was sharp, but then came right back. But the other ones have been fairly mild and come right back. And that's what they know. When I got started in 99, we had like 2 or 3 negative years in a row. Then not, 8 years, 6 to 8 years after that, we had the financial crisis. That was another one really bad year, down 38% in 08. Everything was down too. That's a 1 year asset allocation. Didn't really help. Everything was down. So I think that you make a good point about maybe the younger generation, at least younger than me. I'm 49. Might feel like they have a higher risk tolerance, and I just think that people should understand some of the historical declines and drops and corrections that have happened, and the companies that are the highest price earnings ratios and the highest flyers tend to drop the fastest during those bad times. So keep that in mind, and then keep kind of the big picture in mind the next 10 years. If valuations are high, we're not going to be averaging the 13, 14% a year we have the last 10 years, but you can still make money. You can make money by dollar cost averaging. That's really powerful because you're buying on the dips, and then not just owning large cap, owning some small, some REITs, and then of course, something that creates wheel or something that creates income like wheel.
Great pieces there from Shai as well. I wanted to bring it back to yourself, Patrick, for a second, just see if you had additional thoughts on what's been covered here in the last 10, 15 or so.
Yeah, I think there's a thought process going on right now throughout the market, and I think we're all sort of aware of the fact that markets hate uncertainty, right? And there are a lot of uncertain things that are coming our way, not just domestically, but globally. And so just keep that in mind as you're structuring your portfolios, and look for opportunities to invest in things that have more of a bandwidth of, I want to call it, if we're just in a sideways trending market, right? It's really important to make sure that you are properly diversified, but you're also in the right asset classes, and you're also in the right framework of being able to succeed. Because again, I look at my daughter, I look at people who are new to investing, if you will, and all they see is what Eric mentioned. It's like, wow, this has been great. This is a fantastic market. Why shouldn't it all keep going? Well, we all know it doesn't, and there'll be blips, but again, that's the whole long-term conversation. It's like, can you stomach the ride? And I personally think that a more vigilant eye is required at this point in time. So I'll leave it there. Thank you.
Great points from yourself as well there. We've got one or two others on this panel. Evan, did you have any comments you wanted to chime in with here? No worries if not.
I wish I could, dude. The noise around me must be crazy right now. I'm just very much...
Okay, you might just not be in a great spot. Okay, Eric, I know you'd wanted to run originally 30 minutes, and you've been on for about an hour, and we did about 45 minutes on this topic. It would be good here to maybe spend just 5 minutes kind of at the end of this, just recapping for everybody, some of the more key pieces, and then just explaining to them what you're doing with Wheel, and then we can close it up from there if you'd like.
Yeah, just to recap, in my opinion, as someone that allocates wealthy individuals, and I hear this from institutions and endowments, people that really, they don't want to be sitting here 10 years from now saying, oh man, I took a chance and it didn't work. They want to have a relatively predictable outcome, at least in the long run. Proper allocation. If you got over 10 years, you don't necessarily need bonds, but you need a mix of different stocks. Baskets of large cap, could be mutual fund, could be ETF. Baskets of small, real estate, some small cap, a little bit of emerging markets, a little bit of international. That's going to be probably the most, the more surefire way to get where you want to be without massive swings. And with our strategy, we're going to be in the alternative category, neither stock nor bond. And we are trading capital gains for current income. So we're going to be, we're going to pay that nice quarterly dividend. We don't need the markets to go up to get it. We're going to be less volatile than SPY, but don't put money you need next month in this. But if you have a few years, then absolutely, and know that you're getting access to a strategy that is probably more in the hedge fund world because it's pretty complex, and you're getting it in a publicly traded vehicle for $20 a share. So.
Great points all around. If anyone hasn't yet, ticker that Eric has been talking about here, WEEL, the Peerless Option Income Wheel. Like he mentioned, the goal here is to stick probably around that $21 area and to continue to be able to get out these amazing distributions as well. And so just continue to see more activity around this. And if anyone does have questions, you can, of course, DM myself. You can DM directly to Eric. We do spaces twice a month where we talk about this, take questions on them as well. Patrick, did you have any final comments here for the space?
No, I think what we again, I'll just come back to the fact that markets change, and just be prepared to embrace the fact that it might not be as sanguine. It might be a little bit more volatile going forward. That's all we can really predict, right? It's will stocks go up, down? Who knows? But we certainly are preparing ourselves for some more volatility and maybe less return as we've seen, especially in the equities market, given the valuations that Eric mentioned. And so a strategy like this is probably well to be considered at this point in time. So thanks for having me on. I appreciate it.
Yeah, I completely agree, right? I think that this is the type of thing that you're able to, of course, do your due diligence, not financial advice ever on my end, but I certainly can look into and do your research on as a potential addition to a portfolio for the long term, especially with market conditions like these. Rob, did you have anything else you wanted to add?
No, sir. Check out our website, peerlessetfs.com. Message us, DM us. There's info@peerlessetfs.com is our email on there. Just reach out with questions, and we're always around.
You guys rock. Pleasure working with you guys as always. I'm a big fan of the Peerless team and excited to continue to work together to distribute information around this and content and just talk to more people, because you guys have created something very unique, and I'm excited to be able to share that with the world, as is so many others on this panel and elsewhere. Eric, thank you as always, a wealth of knowledge. You bring a really unique perspective to our spaces that I think is necessary. Do you have any final comments before I close out?
No, I appreciate everybody taking the time and learning about our strategy.
Thank you so much. All right, well then I wish yourself and Patrick, Rob, the whole rest of the panel a great rest of your Monday evening. That's going to do it for the spaces today, and we'll be back on tomorrow at noon. Take care, everybody. Have a great one.